So now let's get started with the revision of the fifth chapter, which is working capital, management of working capital. Now, what is this chapter all about? So as usual, let us first bring the context and let us see why we are studying this chapter, and then we will proceed into the technicalities of this particular chapter. Now, as we all know, our subject financial management has broadly three objectives. So what are the three objectives that our subject financial management has? Yes, the first one is financing decisions, that is taking decisions with respect to raising of funds, raising of capital. Then you have investment decisions, that is taking decisions regarding where these funds need to be invested, right? And then finally you have dividend decisions, right? Now, we saw some chapters in financing decisions like your cost of capital, leverages, and your capital structure decisions. Then investment decisions, we saw the capital budgeting chapter. Yes. Now, in dividend decisions, there's a separate chapter called dividend decisions. Now, this chapter, working capital management, working capital management. Now, where does this chapter fit into? Or in other words, this chapter fits into which of the three objectives? Now, strictly speaking, this working capital management is actually something separate by itself, or if you want to plug it under any of these three objectives, the most relatable objective under which you can classify the working capital management is your investment decisions. I will just tell you what it is and all. I will tell you what it is. You need not have to worry. But this can also be classified under financing decisions. But that is the reason why I'm saying I don't want to bring it under any classification. This working capital management, you treat it as a separate animal as such. It is a separate study as such, called as working capital management. Are you clear with this? I will just go about the introduction. I will tell you what is working capital, why we are studying all these things. And of course, there are a few concepts that we have studied in costing that needs to be related while studying this particular chapter. Are you clear with this? So for the time being, you just understand this is a separate study under financial management by itself. So don't try to plug it under any of the three objectives, because in this chapter you have both the financing decisions as well as the investment decisions. How it is, I will tell you as we proceed into this particular chapter. So now, what do you mean by working capital? What do you mean by working capital? Working capital means current assets minus current liabilities. This is something that you have already studied. This is something that you would have already studied even right from your school days, your 11th and 12th, wherever, right from your commerce, in your accounts, you would have studied all these formulas. Working capital refers to current assets minus current liabilities. All these things are fine. But now we are going to look at this logically. We are going to understand what exactly do you mean by working capital and all. Clear with this? Now, what has happened? The company has chosen the sources of finance, correct? Let's again drop the balance sheet of the company. There are multiple sources of finance like equity share capital, your retained earnings, preference share capital, your debentures, right? There are multiple sources of finance. So the company has designed the optimum capital structure. They have decided from which source of finance, how much should be the amount raised. Financing decisions is over. Now, once this is over, they have also purchased all their fixed assets. That is, they have taken the capital budgeting decisions, investment decisions. The company has purchased a nice big factory. Inside that, all sophisticated machines are all there. Everything is set right now. Now, the company has raised money and they have also purchased whatever they want. All the fixed assets, the equipments and all have been purchased. Now, can I start the business today itself? Right from this second, can I start the business? I have everything with me. No, I have all my factories. I have my inside the factory. I have all my sophisticated machinery, equipments. I have everything, right? So can I immediately start my business? Let us say I am a pen manufacturer. Fine, I have everything right now. Can I start my business? No. Why? Because for you to start your business, yes, you have all the facility. All the facility is there with you. Yes, no doubt. But to start your business, you need to first purchase some raw materials, correct? Then you need to actually function, start the factory, correct? And you need to put your workers to actually convert this raw material into a finished goods. For this conversion, you also need some electricity, power and all. Are you clear with this? There are so many things that are required for my day-to-day running of business. Yes. So technically speaking, my fixed assets are not the only investment that goes into the business. There is also something that I actually need to run my day-to-day operations, and that is called as working capital. That is called as working capital. So what is it? What is it? Can you explain it? Now let us just take an example. Let us just take an example. Why do we need working capital? Let us just take an example. Now I have all these things set, long-term sources of finance I have raised, yes, and then I have purchased machineries, equipments, and everything is set. Now I need to start my business. Let us say I get my first order. Let's say I am getting my first order from a big client. Okay, I'm a pen manufacturer. I'm getting an order from a big client. Now, what happens is, now this company is saying, for me to get this order, this company is saying, my client, they want to know whether I have the capacity to fulfill my honor. That is, I have the capacity to fulfill my commitment. That is, I have the capacity to fulfill the order. So what they are saying is, look, you should readily have 3 months of your raw material stock. Whatever is a raw material stock that you generally have, it should be held with you for a period of 3 months. Only if you hold your raw material for 3 months, I will be ready to accept your order. Or in other words, I will be ready to give you this particular order. So now what they are saying is, first, what the company does. So first, they introduce cash into the business. So I am the pen manufacturer. I bring in cash, correct? Now, using this cash, what I do, I purchase raw material, right? I purchase raw material. Now, what happens? The raw material, I need to keep it in my stores, in my godown for 3 months. Let us say that is the precondition of this order. Generally, I maintain 3 months of stock in my godown. Clear? Now, after this raw material needs to be converted into WIP, correct? So let us say for a period of 3 months, the raw material stays in my godown. After that, I will issue this raw material into my factory shop. That is, the production will start. Let us assume the production will take 1 month. Okay, let us assume for the raw material to get converted into an FG, that is in WIP stage, the entire process will take about 1 month. Yes or no? Now, after this, immediately will I be getting the cash? No. This WIP will be converted into what? This WIP will be converted into an FG, correct? This WIP will be converted into an FG. Now, let us say in this FG, let us say generally, the company holds this for, let us assume, 1.5 months. So the moment I manufacture, the moment I convert my raw material into FG, will I immediately able to sell it? No. Let us say that it needs to stay in my warehouse for a period of 1.5 months. Then what happens? After this FG is actually present, now what I will do? I will sell the FG. Now, if I sell the FG, will I to get the cash today itself? No. What will happen? My customer will ask for some credit period. So there will be debtors. Now this guy says, no, I want 2 months time to actually pay you the money. So after this 2 months only, I will be getting my cash back. Correct or not? Or in other words, first if I introduce cash into my business, yes, I need to purchase raw material, and the raw material stock will remain with me for a period of 3 months. Correct? Then what happens? This raw material needs to be converted into an FG, and for the conversion, it takes 1 month for me to produce. The moment I complete my production, I cannot sell it immediately. It will be in the finished goods will be in my warehouse for a period of 1.5 months. Right? After that, when I am selling, I will not be able to get the cash immediately because the debtors are asking me a credit period of 2 months, and after that only I am able to get the cash. Or in other words, if you see here, so if I introduce cash into the business, when will I get back this cash? it takes 3 months plus 1 month plus 1.5 month plus 2 months, correct? So 3 plus 1, 4 plus 1.5, that's going to be 5.5 plus 2, 7.5. So in this example, just an example, so technically it takes 7.5 months for me to get back my cash. The time period that I take to actually bring my cash back into my business is called as working capital cycle. It is also known as operating cycle. Are you clear with this? So what is this basically? So now apart from my investment in my all my fixed assets and machinery, for me to run my business, I need to introduce cash, correct? I need to bring in an investment. This investment is for what? This investment is to purchase raw material, and then there are some factors of production, labor, overheads, and all I need to incur for the purpose of converting raw material into FG, and that FG cannot be sold immediately. It will stay as FG stock for some period, and then it will be converted into a debtors for some period, and after that only I will get back my cash. This cash includes profit. So what I actually introduce into my working capital cycle will be my investment, but finally what I get back will be slightly more than the investment. Why? Because debtors is at sales price. Sales price will include a margin. Are you clear with this? So basically what will happen, look, this is what happens. Just an example. Let us say the overall working capital, just an example. The overall working capital is how much? Let us say 100 crores. The overall working capital is 100 crores. Now, let's say for the cycle to get over, after let us say this working capital cycle of 7.5 months in our example, let us say I will get 105 crores. This includes profit. Clear? Now, what will I do? Can I take back this 105 crores now? No. The next working capital cycle will continue. Why? I am running a business. So obviously the cycle needs to keep on moving. The moment 7.5 months gets over, the next working capital cycle will start. Now what I will do, in the second cycle, I will invest back 100 crore rupees. Correct. And then it takes another 7.5 months to come out of this. Correct. So basically, out of this working capital, in this working capital cycle, I introduced 100 crores. At the time when I get it back, I will definitely get slightly more than that. So ideally speaking, I can take this 5 crores out of my business, and this 100 crores again needs to be reinvested back. And this 5 crores, I can use it to actually finance. I can use it to pay my interest on whatever is the loan that I am borrowing. Let me come to that in a short while from now. So basically, this working capital is a permanent amount that gets blocked into the business, and now it gets released after the cycle gets over. Again, it gets reinvested for the next cycle. Then after that cycle gets over, again it gets released. Then again it should get reinvested, and the cycle goes on forever. Now, when will the cycle stop, sir? When the company stops the business. In the last cycle, yes, after that you need not reinvest it back. You can just take back the entire working capital amount. This is why, let's connect the dots. This is why I said in the previous chapter, that is in investment decisions, I told you your working capital is an outflow initially, and at the end of the life of the project, it becomes an inflow. I told you, right? So basically, this 100 crores I'm putting into the business, it's not a cost, it's an investment. So I need to invest this amount. It gets recycled once again, and life just keeps on going. Are you clear with this? So basically, I need to introduce this extra 100 crores into my business. This 100 crores is my working capital. Are you clear with this? Now, I need to bring this 100 crores into my business. Yes, I need to bring this 100 crores. This is over and above my capital investment, that the amount that I invested in my plant and machinery, all the equipments and all that. Now, and this is a cycle that keeps on going. So the moment I borrow this 100 crores and introduce it into the business, it always remains in the business. Now, I need 100 crores for what? For my working capital, day-to-day functioning. Now, how can I get this 100 crores? Broadly, there are two ways. So working capital investment, how much is the working capital investment amount that I need? 100 crores, correct? How will I finance this working capital? There are broadly two ways. One is you can go to a bank and you can ask them for a loan. Now, remember this one thing very clearly. How much will you ask them for? 100 crores. Now you tell me, this 100 crores, can you repay it after 7.5 months? No, this is a long-term loan. Why? So after 7.5 months, in this example, 7.5 months, after this working capital cycle, again this 100 crores needs to be reinvested into the next cycle, and it just keeps on going like that. But what happens is, every time the cycle gets over, I get an amount that is slightly more than my investment. Using this extra money, I can pay them the interest and I can keep on servicing the loan. Are you clear with this? So technically, when you are borrowing money, when you are funding for working capital, that is also a long-term borrowing only. Are you clear with this, guys? Are you clear with this? So when I go for sources of finance to fund my working capital, remember that working capital is generally a long-term source of financing, right? Now, what is the alternate source? What is another source for financing your working capital? This could be your current liabilities, that is trade creditors or bank OD, etc. Short-term borrowings, etc. Sir, what is this? Now, you look at this, what I said. Once I bring in cash into the business, right, I am purchasing the raw material. The raw material stays in my stock for a period of 3 months, correct? So technically, immediately once I make the investment in my raw material, I cannot convert it into money. It stays idle for a period of 3 months. After that, another 1 month is required for converting it into FG. Yes, and then 1.5 months it remains in the FG stock. Then 2 more months it takes to actually convert it into my debtors. Correct? Now, what I can do is, instead of financing this entire amount, I can go to my supplier. The supplier is what? The supplier of raw material. I can ask him, sir, I am also doing a business, so I am having this cash liquidity and all. I will continue to do business with you only. I will be your customer. You don't worry. I will purchase only from you. But you don't ask me to pay the cash today itself. You give me some credit period. You give me some credit period. You allow me time for payment of this particular raw material. I will not pay you today itself. You just give me 2 months credit period, sir. So I will pay you after 2 months. So technically speaking, my funds get blocked into the business for a 7.5 months, no doubt. But now in this case, out of the 7.5 months, 2 months, this raw material supplier, he is ready to fund you indirectly. Or in other words, he says he is not funding me by way of paying me cash, but he is funding me by supplying the raw material. So he says, I will give you the raw material today. You need not pay me today. You pay it to me after 2 months. So indirectly, it is also a source of finance only, correct? So technically, my gross working capital cycle is 7.5 months, but out of the 7.5 months, 2 months, this guy, my supplier, is ready to bear the burden. So technically, my net working capital cycle is now reduced to 5.5 months. Or in other words, this trade creditors are also an indirect source of financing. Are you clear with this? So that is the reason why working capital is generally called as current assets minus current liabilities. Current assets we saw here, 3 months for raw material, 1 month for WIP, 1.5 months for FG. All these are inventories. 2 months for debtors, correct? Gross working capital 7.5 months less creditors gives me a credit period of 2 months. So net off, if you do overall, the net 5.5 months is going to be my working capital cycle. So technically, the period that I take to convert cash into cash is called as working capital cycle, and this is partly funded by external sources of finance like bank loan and all that. The other one is imbibed in the cycle itself, that is by way of trade creditors and short-term borrowings. Are you clear with this? So the reason why we call working capital as current assets minus current liabilities is this is the gross amount of investment that is required for my day-to-day functioning. Out of this, to the extent of current liabilities, it is being funded by my suppliers, etc. Are you clear with this? So the net funding that I need to bring into my business for the purpose of running my day-to-day operations is called as working capital. Are you clear with this? So now working capital, two things are there. You should find out how much amount of working capital you need for your business, correct? Then once you find out the amount, you should next find out how will you fund this, correct? So there are two decisions that you need to take in this particular chapter. The first one is working capital investment. How much is the amount of working capital I need for my business? That is number one. Number two, yes, I know that I need 100 crores. Now, how am I going to fund it? That is the secondary decision. That is, how am I going to finance this working capital? That's why I said this chapter is both financing decisions as well as your investment decisions. But then the only issue here is we are talking about current assets and current liabilities, so it is slightly different. From what we saw in our capital budgeting and all. Are you clear with this? Yes. So now let us just go to this particular area. So management of working capital. Now in our study material, generally this chapter gets tested for 10 marks. Now this chapter is divided into 6 units as per our ICAI study materials, divided into 6 units. Introduction to working capital management, this is the basic concepts of working capital. Then they go on to explain each and every component of working capital. So working capital is what? Current assets minus current liabilities. So current assets typically can have what? It can have stock, correct? Then it can have debtors, then it can have cash, correct? Right? Then current liabilities can generally have what? Payables, correct or not? Or creditors, yes. So each of these components, there are some decisions that you need to take that are covered here. Look at this: treasury and cash management, management of inventory, management of receivables, management of payables, and finally you have something called as financing of working capital. This is technically a theory area. Clear? So overall, the scope of this chapter is, the first part is about the general study of this chapter. Then the next 4 units are regarding studying certain different components of working capital, and the last part is about how am I going to finance. So this is basically a theory part. So this is going to be the agenda for this particular chapter. Are you clear with this? So working capital is nothing but current assets minus current liabilities. So current assets include what? Inventory. Inventory means it includes your raw material, WIP, finished goods, receivables, cash or cash equivalents, prepaid expenses, and all of that, right? And then your credit, your current liabilities will include the payable and any kind of outstanding payment that you've got. Okay, so now working capital management on the basis of value. Gross working capital, net working capital. Gross working capital means what? Your current assets. Gross amount is current assets. Net working capital is current assets minus current liabilities. Are you clear with this? Are you clear with this? See, gross working capital refers to the firm's investment in current assets, whereas the net working capital refers to difference between the current assets and current liabilities. Now, on the basis of time, working capital can be classified into permanent working capital, fluctuating working capital. Permanent working capital is this amount that I told you, this 100 crores. At any given point of time, I need this 100 crores for my business, correct? Now, let us say for one season alone, let's say I am a sweet manufacturer. During Diwali time, I have an excess demand. For that period alone, for my day-to-day operations, since the demand is more, I need to have more funding. But once the Diwali season gets over, then I can just push it away. I can just remove this investment from my business and take it back. So the short-term requirement, suddenly for seasonal extra requirement, if I need, that is called as fluctuating working capital. So permanent working capital means what? The amount of working capital that I need generally at any given point of time for running my day-to-day operations. Whereas fluctuating working capital means the extra working capital that I might need seasonally, occasionally in my business. Are you clear with this? Yes. And a positive working capital indicates the company's ability to pay its short-term liabilities. So what do you mean by working capital? Current assets minus current liabilities. So if the current assets is more than your current liabilities, it means that even in a worst case scenario, tomorrow if everything goes wrong, you're shutting down your business, now if I sell all my current assets, that value itself will be sufficient to pay my current liabilities, correct? So it talks about the solvency of the company, short term solvency of company. Even if something goes wrong, if I sell my current assets, the amount that I'm able to generate from the current asset should be able to recover my current liability. So generally it is ideal to have a positive working capital. Are you clear with this? Yes. So now, why do we need adequate working capital? Now, what do you mean by the word adequate? Adequate means not high and not less. Remember this. What do you mean by adequate working capital? The working capital that you have in your business, it should not be too high, it should also not be too less. Sir, why, sir? A large amount of working capital would mean that the company is having idle funds, correct? Now 100 crores I'm saying I need for working capital for running my business. If you're borrowing 100 crores now and you're putting it in your business, this 100 crore rupees is blocked in your business. It is not a cost. It is blocked in your business. This can be released only after you permanently shut down your business, correct? So for this 100 crores, there is a cost that comes along with it. Now more, let us say I want to be more cautious and I borrow more and I have more working capital. You tell me the cost that comes for financing this working capital will now increase for me. That is a huge burden. So I should not have high working capital because the funds are blocked into my business. It remains idle. Sir, then if we have less working capital, what will happen? That is also bad. Inadequate working capital. If you have a lesser working capital, what will happen? You will not be able to meet your day-to-day commitments. Let us say you are investing lesser amount of money in your purchasing your stocks and all that. You get a huge order today. He's saying, I immediately want this particular order, so give it to me. Because of lesser working capital, you are not able to fulfill that order. So now what happens? You are losing out on your business. So there will be some opportunity losses and all. So this is what it is. The firm runs the risk of insolvency. You will not be able to generate business. Now what happens? Your current assets will not even be sufficient to recover your current liability. The paucity of working capital. Paucity means scarcity of working capital may lead to a situation where the firm may not be able to meet its liabilities. It may also mean that the firm may not be holding enough inventory in order to meet the customer's demand and hence would lose the sales and eventually some reputation as well. So basically, the working capital investment in this company, in any company, should neither be too high, it should not be too low. Why should it not be too high? Because your investment, the working capital investment, comes with a cost. So it's basically an amount blocked in the business. More the amount blocked in the business, more will be your finance cost associated with your working capital borrowings, correct? Then what happens if you have lesser working capital? If you have less working capital, you might lose out on your opportunities to run your day-to-day operations and it will affect your solvency position. So what is the most important thing here? You need to maintain adequate, means what? The right amount of working capital. Are you clear with this? Now determination of working capital. Yes. So this is what it is. Now what it is, look at this. In the scope of working capital management, now we will be reading something about liquidity and profitability. Then investment and financing. Investment and financing, I told you. Investment talks about how much amount of working capital I need. Financing talks about where from I am going to get this amount. Where from I am going to get this amount. Clear? Now, what is the issue relating to liquidity and profitability? Liquidity means what? Liquidity means what? Liquidity means having more cash. Having more cash is called as liquidity. Profitability means what? Having more profit. Remember, these two are different things. More cash does not mean more profit, and more profit does not mean more cash. What it is, we will see. For uninterrupted and smooth functioning of day-to-day business of an entity, it is important to maintain the liquidity of funds evenly. Liquidity means what? You should have the cash in the business. Clear? As we have already learned in the previous chapters, each rupee of capital bears some cost. So while maintaining the liquidity, the cost aspects need to be borne in mind. Also, a higher working capital may be intended to increase the revenue and hence the profitability. If you have a high working capital, what will happen? Now you have more funds, so you can generate more sales. More sales if you generate, what happens? More profit will be there, correct? But at the same time, Unnecessary tying up of funds and idle assets not only reduces the liquidity but also reduces the opportunity to earn a better return from a productive asset. So what happens right now, this is one side of it, but the other side of it, what happens here is now you are tying up more funds in your business. Because of this, there is some cost associated to this. Clear? Hence, a trade-off is required between liquidity and profitability. Sir, which is good, liquidity or profitability? No, you cannot say that this is only best. There needs to be a trade-off. Means what? Balancing between the two. Right? More liquidity, less profitability, that is also bad. More profitability, less liquidity, that is also bad. So you need to strike a perfect balance between the two. Ensure that there is sufficient cash, and with this sufficient cash, you are also able to generate sufficient profit. That's about it. Are you clear with this? This is all about 3 E's. That is economy in financing, efficiency in utilization, and effectiveness in achieving the objectives. All these are theoretical parts. Are you clear with this? Fine. Now, this is what I said, investment and financing. Investment means how much amount is required. Financing of working capital means where from the amount is required, right? And estimation of working capital needs, I told you, this is also called as working capital operating cycle, also known as working capital cycle. It's also known as cash cycle. So generally it is done by way of holding period of assets. I told you, right? So I need 3 months for my raw material stock. Then my raw material stock remains in my godown for 3 months, and then it takes one month or 1.5 months for me to convert it into an FG and all of that. We will be seeing a comprehensive numerical sum, so don't worry about it. Now let's get started with this first problem. By way of this problem, we will learn more about this working capital, right? So first, let's get started with this problem. On 1st January, the managing director of Naurin Limited wishes to know the amount of working capital that will be required during the year. From the following information, prepare the working capital requirements forecast. So the managing director of a particular company, he wants to know how much is the amount of working capital investment that is required for my day-to-day running of my business, right? What they are saying. Production during the previous year was 60,000 units. It is planned that this level of activity would be maintained for the present year also. So the upcoming year, I'm going to produce how many units? 60,000 units. The expected ratios of cost to selling prices are given as follows. Raw material is generally 60% of my sales value. Direct wages is generally 10% of my sales value. Overheads is generally 20% of my sales value. So raw material 60, wages 10, and overheads 20%, right? Next, raw materials are expected to remain in store for an average of 2 months before being issued to the production. So basically they are saying, if I purchase a raw material today, immediately I will not start converting into an FG. It has to wait in the godown for 2 months. It is the company's policy, correct? Then each unit is expected to be in the process for 1 month. The raw material being fed into the pipeline immediately, and the labor and overhead cost accruing evenly during the month. What they are saying? So raw material stock 2 months. They are saying WIP, what will happen? It remains in the process. It takes 1 month for them to convert the RM into WIP. Clear with this? So then and there, evenly your raw material will be fed into this particular machinery, and evenly the production will happen. The labor and overheads will be incurred evenly during the course of this particular month. Then once the production is completed, finished goods will be there. Now immediately finished goods, can it be sold? No, it has to stay in the warehouse awaiting dispatch to customers for approximately 3 months. So finished goods, my money gets locked up by way of finished goods for a period of 3 months. Then credit allowed by creditors is 2 months from the date of delivery of raw material. Credit allowed to debtors is 3 months from the date of dispatch. Now, after FG, what happens? Debtors. Now, immediately will I be able to generate? The moment I sell my FG, will I be able to generate money? Will I be able to generate cash? No. The debtors say that they want 3 months of credit period, right? But wait, parallelly the creditors are also saying that the creditors are saying that they will give me 2 months of credit period. So this is an advantage for me. Are you clear with this? Yes. Next, selling price is 5 rupees per unit. there is a regular production and sales cycle. Wages and overheads are paid on the first of each month for the previous month, and the company normally needs cash in hand to the extent of 20,000. What we need to do, we need to calculate the working capital requirement, right? So pause this video right now, read this question once, and then let us continue with the discussion further. So now, first, let us calculate the component wise amount that gets blocked into the business. Component wise amount that gets blocked into the business. Now, recall, in costing, we have learned something called as cost sheet, right? Fine. If you do not know, if you have not learned costing, if you're directly entering into FM, right, there's something called as cost sheet. So what is basically a cost sheet? What is basically a cost sheet? In cost sheet, basically we have direct material plus direct labor plus direct expenses. It gives you something called as prime cost. To this, you will add your production overheads. You get something called as gross works cost, right? Add opening WIP minus closing WIP. You get something called as net works cost, or popularly known as factory costs, right? From this, add your opening FG minus closing FG. You get something called as cost of goods sold. To this, you will add administrative overheads and add selling and distribution overheads. You get something called as cost of sales. To this, if you add profit, you will get the sales value. Now, basically, this is a format of cost sheet. So what happens is, for me to produce and sell one unit, what are all the costs that I will be incurring? Direct material, direct labor, direct expenses, correct? So all the direct expenses put together is called as prime cost. To this, I will also be incurring some indirect expenses that are incurred inside the factory. Example for production overheads, indirect expenses incurred inside the factory. This is going to be factory rent. Just an example, right? Now, if I add all these things, I get something called as gross works cost. Now, not every units are completed in all aspects. So the incomplete units are called WIP. So adjust for WIP, add opening WIP minus closing WIP, you get the net works cost or the factory cost, correct? So this is also known as cost of production. That is, for me to produce every single unit, I incur material, labor, direct expenses, and production overheads. Or in other words, I incur all the costs incurred inside the factory. Yes. To this, I adjust for my opening and closing FG. I get cost of goods sold. Correct? Yes. Now, I add my administrative overheads and selling overheads. So, what do you mean by administrative overheads? Any expenses incurred for my administration activity. For example, I can call it as office rent. Correct? Office rent, or I would say MD salary, all these are administrative overheads. Selling overheads, the example for selling overheads will be sales commission, or we can even say warehouse rent, correct? Warehouse rent. So any kind of indirect expense incurred in the sales area is called as selling and overheads. So to my cost of goods sold, if I add my administrative overheads and selling overheads, I get the cost of sales. What do you mean by cost of sales? The cost incurred in respect of every unit sold. But whereas what is the cost of production? This is nothing but the cost incurred in respect of every unit produced. What is the difference between the two? Here, only the cost incurred inside the factories are considered. That is nothing but direct material, direct labor, direct expenses, and production overheads. Whereas in case of units sold, apart from over and above my cost of production, I will also incur my administrative overheads and selling overheads. Are you clear with this? To which if I add profit, this is going to be my sales. Now I'm just giving you a bird's eye view of this particular cost sheet. Now in cost sheet, in your costing paper, cost sheet will have a few more line items, like there will be something called as research and development expenses, quality control cost and all. Technically, all of that is a part of production overheads. There it's more format driven, but right now here we are just looking at it from a conceptual viewpoint, which is relevant for the purpose of this particular chapter, working capital management. Now, what they are saying. Now, I should calculate the amount of working capital that I need to be invested into my business for my day-to-day operation. Now, what they have said, the company is planning to produce how much? 60,000 units in this particular year. 60,000 units of what? FG, correct? Now, what they have said, generally raw material comprises of 60% of the cost. 60% of the cost for what? The 60% of the cost of my sales, correct? So now you tell me, raw materials, if I buy today, I will be keeping it for a period of 2 months before I issue it to the production. So basically, what is the amount of investment that is required for raw material? Can you tell me? Now, can I say this is nothing but, look, the cost of materials for the whole year, this is cost, not the investment. Cost of materials is 60% of the sales value, correct? So what is the total sales? They have given 60,000 units they are going to sell. Every unit is going to be sold at rupees 5, correct? And they have mentioned that 60% of my sales value is generally my raw material cost. I'm not talking about raw material investment. This is the raw material cost, correct? So generally in a year, the raw material cost is going to be how much? 1,80,000. Now, should I introduce 1,80,000 right now itself? No. I just need to first, in my first working capital cycle, I just need to introduce 2 months equivalent of my raw material consumption. So in one working capital cycle, I just need 2 months of my annual consumption. Annual consumption is going to be 1,80,000 rupees worth of raw material. But for my per working capital cycle, I only need to fund for 2 months. Or can we say the raw material amount, the raw material value that gets blocked into my working capital cycle will be 1,80,000 rupees into 2 divided by 12. So how much is this? So into 2 by 12, this is going to be 30,000 rupees. So first, the amount of raw material, the funding of raw material, the amount of raw material that gets blocked into the business is going to be 30,000 rupees. Are you clear with this? This 1,80,000 is the annual raw material cost that I will be incurring, but I'm talking about how much amount of working capital investment I need to bring in. For this, I need to actually stake some finance also. I just need to take up the funding for this. So 2 months equivalent of my annual raw material cost is only the amount of raw material that gets blocked into a particular working capital cycle. Are you clear with this? It's enough if I just fund for the first working capital cycle. Why? Because now if I fund my one working capital cycle, obviously it will generate cash. That cash generated from the first cycle can be used for the second cycle. Then the cash generated from the second cycle can be used for the third cycle. Or in other words, basically the amount of working capital investment that I need is basically the working capital investment pertaining to one cycle. Are you clear with this? And in that cycle, there could be current assets and current liabilities. In that current liabilities, one of the components is going to be raw material. So raw material, how much amount I need in one particular cycle? I need 2 months of my annual requirement. Annual requirement of raw material is 1,80,000. 1,80,000 into 2 by 12, 30,000 rupees would be the raw material amount that is required in the business. Are you clear with this? Then what happens? Then this raw material now needs to be converted into finished goods. This process of conversion is called as WIP, correct? Now you tell me, guys, what happens is, now for a period of 2 months, raw material remains as raw material. It is not touched by anyone, correct? Then what they are saying, next, it takes 1 month. It takes 1 month for the company to carry out the process. Or in other words, for the next 1 month, the processing happens, correct? Now, during this 1 month, when I am processing, the entire raw material will be blocked, correct? That is, the entire raw material is utilized for this 1 month of processing. Apart from that, for this processing, I will be having labor as well as overheads, correct or not? That is, for a period of first 2 months, raw material costs gets blocked as such. Then for the next 1 month, raw material will now enter into the WIP area. So now the cost gets accumulated. Over and above the raw material cost, I will also be incurring labor cost and I will also be incurring overhead cost. Are you clear with this? So in my WIP area, what happens? The amount of the value of WIP. So basically the value of WIP is what? The WIP is valued at material plus labor, direct expenses if it is given, plus overheads. So every unit that gets processed, now the amount that gets into the value of the WIP will not just be raw material, it will be labor and overheads should also be included. Now look at this, what they have given. Each unit is expected to be in process for 1 month. The raw materials being fed into the pipeline immediately and labor and overhead costs accrue evenly during the month. What they are saying. Look at this. Very, very important. Now, look at this. This is a machine, right? This is a machine. Now, what they are saying, first, raw material. I had this raw material for 2 months, right? We saw the raw material was remaining as raw material untouched for 2 months. Now what happened? Once this 2 months got over, now I poured this entire raw material into what? Into this machinery. This is where my processing happens. So what happened? This entire raw material, it entered into my machine, correct? Now on this, immediately this raw material will not get converted into an FG and go out. No, it will take 1 month time to convert this raw material into an FG. Are you clear with this? That processing is called as WIP. Now, what they are saying is raw material cost is incurred at the beginning itself. The moment the WIP process starts, entire raw material is poured, correct? But the process of conversion takes 1 month time, or in other words, conversion costs is nothing but your labor and overheads. But the labor and overheads overnight I will not incur. It incurs evenly during the course of the entire month. That is, I will not be incurring the labor cost and overhead cost in a single day. Every day people will be working, the power will be consumed evenly for the entire month. Only the labor and overhead cost will be incurred, whereas the raw material cost, it is incurred at the beginning of the month itself. Are you clear with this? So can I say this raw material cost gets locked for a period of 1 more month inside this working WIP? Are you clear with this? So can we say in this WIP, raw material stock gets locked in for 1 more month, correct? Or this is nothing but 1,80,000 is the annual raw material consumption, correct? Into 1 divided by 12. So 1,80,000 by 12, how much is it? 15,000 rupees. So inside my WIP consists of raw material, labor and overheads, correct? So now the raw material sitting inside my WIP is 15,000 rupees. That is 15,000 rupees worth of raw material gets blocked at the time of processing for a period of 1 month. This is the meaning. Are you clear with this? Now WIP is not just about raw material. It is some processing happens. So labor and overheads will also be incurred. Now what they are saying, look at this. Please look at this very, very carefully. They are saying wages is generally 10% of my sales value. Overheads is 20% of my sales value. Fine. Now in a year, what is the total wage cost that I will be incurring? Can I say it is nothing but 60,000 into 5, correct? 60,000 into 5. This is my overall sales value, correct? On that 10%. So that is 30,000 rupees will be the labor cost that I will be incurring for an entire 1 year, for an entire year. Now, when what are we talking about? Working capital. So we are talking about the amount of working capital investment that we need to bring in. Now, we are not talking about the cost of labor that I'm incurring. We are just saying at the time of actually starting for running my business, how much amount of this particular labor cost I need to bring in. That is the point I'm saying, because in a year there could be many working capital cycle. I am just talking about one cycle. The requirement of labor costs inside my WIP in one particular cycle is the topic that we are talking about right now, is the particular issue that we are talking about right now. Now, what they are saying is, sir, I need 1 month of wages in advance itself. No, correct, because wages also gets blocked for a period of 1 month. No, no, this is not like raw material. If you see, on day one, you incur some wages. Fine. The first day, you don't incur any wages. Actually, the work has not yet started. Day one, you slowly start incurring some wages. Day two, you incur some wages. Day three, day four, day five, and the 30th day, you incur the full wages, and the entire WAP gets, or entire raw material gets converted into FG. Or in other words, labor and overheads, unlike raw material, they get accrued evenly during the period of my WIP. Correct or not? Or in other words, at the beginning of this 1 month, I don't incur any labor and overhead costs. Correct? At the end of this 1 month, I incur the entire labor and overhead cost. Correct? For this entire raw material. Or in other words, can I say on an average, can I say 50% is only the amount of cost that gets blocked into my business, and can I say 50% of 1 month, which is going to be 0.5 month. So I need 0.5 months equivalent of labor and overheads to be funded upfront in my business, so that I can smoothly run my operations. Are you clear with this? Because labor and overheads are not incurred at the beginning itself. They are incurred every day. So what we do, since they are incurred evenly, we take a simple average and we say it is not 1 month's requirement, because at the beginning of the period nothing was incurred. At the end of the period, you need to pay the entire labor and overheads. So basically, there is only half months, 50% of the labor and overheads is the funding that I need to bring in. Are you clear with this? And that is what they have mentioned here. It states, so look at this, 30,000 into 0.5 divided by 12. If 30,000 is the labor cost for 12 months, how much will it be for 0.5 months? So how much is this? 30,000 into 0.5 divided by 12, that gives you 1250. Similarly, it is for overheads. So overheads is 20% of my overall sales value, correct? So 20% into 60,000 into 5 into 0.5 divided by 12, you get 2,500 rupees. So overall, in my WAP stock, wow, how much in one cycle, in one working capital cycle, in WAP consists of 15,000 rupees worth of raw material, 1250 rupees worth of labor, 2,500 rupees worth of overheads. Overall, your WAP stock, the amount that gets blocked inside your WAP stock is going to be 18,750 rupees. Are you clear with this? Look at this. It is stated that it accrues evenly during the month. Thus, on the first day of each month, why month? Month is because the processing takes 1 month, WAP. It would be 0, and on the last day of the month, it would include 1 month's labor cost. 100% of the cost will be incurred. On an average, therefore, it would be equivalent to half the month's labor cost. So the funding that I need to bring is pertaining to half a month. Are you clear with this? Sir, annually there is 30,000 I need. No, sir, don't worry about this. Once this is for 1 year. I just need to bring for 0.5 months. That is only a part of this particular cycle. Once this cycle gets over, it will generate cash to fund the next cycle. Are you clear with this? So basically, I need to calculate the working capital requirement for one cycle alone. Once you are able to do it, automatically the cycle will keep on running. That's why we are calculating the working capital requirement for one particular cycle. Are you clear with this? Yes. So now with this, we have finished. The amount that needs to be blocked in your working WAP is 18,750. Clear with this, guys? So in raw material, what is the amount that gets blocked? 30,000 rupees needs to be blocked in your raw material. How much amount gets blocked in your WAP? 18,750 gets blocked in your WAP. Now, how about finished goods? They are saying finished goods, 3 months, 3 months, 3 months cost of production. That is, after producing, first I had my raw material for how much? First I had my raw material for 2 months, correct? Here, only raw material cost was blocked, correct? Then for the next 1 month, raw material cost plus labor cost plus overhead cost, but labor and overheads were incurred proportionately, that is, they were incurred evenly. So I took only 50% of labor and overheads, correct? Now after this 1 month, can I immediately realize cash? No, it will enter into my FG area. It will enter into my FG area, and in my FG, it stays for how many days? It stays for a period of 3 months, correct? It stays for a period of 3 months. Am I right? Now, for the period of next 3 months, what is the amount that gets blocked into my business? Material plus labor plus overheads. This time, everything is incurred upfront. That is, I have incurred all material, labor, overheads, the entire amount of labor and overheads also, not 50%. These are completed goods. Now I don't incur anything now. I just keep it idly for the next 3 months. That is because of my business decision. So why would someone keep it idly, sir? Maybe you should, if you always go to actually some wholesale shop now, they will have some ready stock. Why? Because demand can come at any point of time. You don't know. Fine. So if someone comes and asks you, and if you say, sorry, sir, I don't have stock, then it will not look nice. So you will have 3 months equivalent of every year's sale, 3 months worth of stock you will keep with yourself at any given point of time. That is the meaning of this. Correct. So now what is the amount that gets blocked in your FG? Material plus labor plus overheads. Everything is incurred now. Then for the next 3 months, I would have paid for my material, labor, overheads. All the costs have been incurred. For the next 3 months, the FG's value is going to be the extra amount that I need to bring into my business. Or in other words, now if you see, it's very simple. So now you tell me, labor cost, raw material cost is how much? 60% of my sales. Labor is 10% of my sales. Overheads is 20% of my sales. 60 plus 10 plus 20. Overall, can I say the overall cost that I incur, the overall cost for every unit of completed product, can I say is 90% of my cost of sales? Yes. Now what is my sales value? 60,000 into 5 rupees, correct? On that 90% is the cost I have incurred, correct? So can I say 60,000 into 5 into 90%, 2,70,000 rupees. 2,70,000 rupees is the overall cost incurred for the entire period, correct? But I just need to maintain 3 months worth of stock. Only that gets blocked into my business by way of FG, correct? So 3,70,000 into 3 divided by 12. So how much is this going to be? 67,500. So now for the next 3 months, another 67,500 rupees needs to be introduced upfront into the business. So the working capital, how it works is, for a period of 2 months, the raw material cost gets blocked. For the next 1 month, raw material plus evenly 50% of labor, 50% of overheads. Then for the next 3 months, entire raw material, labor and overheads gets blocked in your business. Are you clear with this? Yes. Now what happens? Now, after this 3 months, immediately you will sell it, and can you get the cash immediately? No. What happens now? Now you tell me. So first, what happened? So here, now raw material, 1 second. So first, raw material, how long it took for raw material? 2 months. Then WIP took 1 month. Then FG took 3 months. Now after this 3 months, will you be able to realize the cash? No. Now you have your debtors, correct? What are they saying? How long will the debtors take to pay this money? They are saying the debtors, the time limit allowed for debtors is 3 months. So for the next 3 more months, I will be having debtors, and for the next 3 months also I will not get back my money. Or in other words, the next 3 months amount should also be funded by me only, correct or not? Now what is the amount that gets blocked for the next 3 months? The value of the goods sold. Yes or no? The value of the goods sold. Now you tell me, for every unit sold, now for every unit sold, what is the sales price? What is the selling price? So for every unit sold, the selling price is 5 rupees, correct? Now this 5 rupees includes profit margin. Yes or no? Now profit, is it an amount that I need to block? No, I'm blocking. What is the amount that gets blocked in my business? Only the cost, correct? Or in other words, can I say 60,000 units into 5 rupees into 90% is the overall cost that I incur, cost of sales pertaining to the entire year, which is 2,70,000 rupees, correct? Yes. Now 2,70,000 is the cost of sales made for the entire year. Now I need to fund only to the extent of 3 months in my debtors with respect to my debtors. So 2,70,000 into 3 by 12. So another 67,500 rupees gets blocked by way of debtors. Are you clear with this? Another 67,500 rupees gets blocked by way of debtors, where the total cost of sales is raw material plus wages plus overheads plus opening FG minus closing FG. Here opening and FG, closing FG is not given. We can assume it to be equal. So now your overall value, overall total cost is going to be 2,70,000. This is where I said the format of cost sheet also you can use. Are you clear with this? So now basically what happens? What is the amount that get blocked in your raw material? Now amount that gets blocked in your raw material is how much? Rupees 30,000, right? Yes, the amount that gets blocked in your raw material is how much? Rupees 30,000. Then the amount that gets blocked in your WIP, how much is that? That is going to be 18,750. This also I need to bring into my business initially, 18,750. Then what is the amount that gets blocked by way of FG? 67,500 rupees, 67,500. Then what is the amount that gets blocked as debtors? The amount that gets blocked as debtors is going to be how much? So it's going to be 67,500 once again. It's going to be 67,500 once again. Are you clear with this? Are you clear with this? Now, what happens? What happens? Apart from that, okay, let us also say the company requires some cash balance, all of this, fine. Now, what happens? Now, there is an advantage for the company. What is it? Now, their creditors, their suppliers are ready to give 2 months of credit period. Now, their suppliers are indirectly funding my creditors for what? For raw material. They are saying, don't worry, you need not pay the cash immediately. You pay it after 2 months. But till now, what I have done it on the assumption that cash needs to be paid immediately. Based on that, only raw material stock 2 months and all I have taken, correct? So now from this, I will reduce the amount that gets funded, indirectly funded by my creditors. Yes or no? This is indirectly funded. How can you say it's funded? They are not funding in cash. They are funding it in kind. They are giving you the raw material today. They are saying you pay it after 2 months. Are you clear with this? So now what happens here? What is the amount that they are indirectly funding? What is the amount that they are indirectly funding? Very simple. Annual purchases will be what? 60,000 into 5, that is your total sales on that 60%. 60% on my annual sales is the overall purchase raw material cost, correct or not? Yes, on that 2 months equivalent credit they are giving me. So into 2 by 12, that is indirectly 30,000 rupees of my gross working capital is being funded by my creditors. Are you clear with this? So this 30,000 rupees, I am subtracting it. Why? Because to this extent, my creditors are saying they will finance it for me. This is not a cost. I'm saying about the amount of funding and investment required. Next. Now, they have also said something. What have they said? Look at this. Wages and overheads are paid on the first of each month for the previous month, which means now wages and overheads also these guys are saying, now you need not pay today. This month you extract all the work, you pay it in the first of next month. Or in other words, wages and overheads, we are getting 1 month credit, outstanding wages, outstanding overheads and all. We are getting 1 month credit, correct? Indirectly, these expenses are also getting funded. Yes or no? Now, wages is how much? Wage cost is how much? 10% of my sales value, correct? So 10% of my sales value into 1 by 12 is the funding. So 10% of my sales value into 1 by 12, this is the amount that is actually being funded. I'm not saying this, they are bearing the cost. No, to the extent of this 2,500 rupees, it is being, these workers are saying we will take it later. That is, you need not pay me every day as and when I work. So I will work for 1 month, you pay me later. Because of this timing difference, I require a lesser funding of 2,500, correct? And then overheads is 20% of my total sales into 1 by 12. It's going to be 5,000 rupees is the amount that gets indirectly funded by way of delaying payment in your overheads. Here it is assumed that the inventory level is uniform throughout the year. Therefore, opening inventory equals closing inventory. We've seen it. Now, statement of working capital requirement. What is the amount that I need to bring it initially itself into the business, and this will enter into the cycle and keep on rotating? Raw material, I need to bring in 30,000 rupees. We have already done this. 30,000. Yes. For WAP, I need to bring in 18,750. FG 67,500. Data 67,500. Wait, they have also said at any given point of time, the company should maintain a cash balance of 20,000 rupees, correct, to meet any kind of contingencies. So the gross working capital that the company should meet, that is, they should definitely introduce 2,03,750 rupees. Apart from that investment in all the capital asset, they should have this money to run the show. Are you clear with this? Are you clear with this? Now what happens? Wait. This can be funded by borrowing, or this can also be funded through your current liabilities. So to the extent of current liabilities, how much is getting funded? Creditors are indirectly funding for a period of 30,000 rupees. They are not bearing the cost, since they are saying I am accepting the payment after 2 months. Because of the time gap, you have 30,000 rupees of finance. So from this, I have this gross, this capital assets, that is, sorry, your current assets, your gross working capital has been computed by not taking into account any of these cushions that I have, correct? I'm assuming that the entire payment is being made as and when it is required. But from this, I am now reducing whatever credit period that I can avail. So in the creditors 30,000 rupees, outstanding wages 2,500, outstanding overheads 5,000. So out of this 2,03,750, inside this, the current liabilities itself is funding me to the extent of 37,500. So now I need to introduce 1,66,250 rupees into my business. Are you clear with this? So now what happens? What happens right now? So 1,66,250. Now what will happen? So I will go to the bank. I will ask them working capital loan I want to the extent of 1,66,250. Let us say the bank is giving, or you can also raise it through any of the long-term sources of finance. You are getting it. Now you will introduce this into your, business, correct? Now what is the working capital cycle for this company? 2 months, 1 month, 3 month, 3 month, and then creditors give you 2 months credit period, and then your overheads, right? Your labor and overheads, you have about 1 month each. Labor and overheads, you have about 1 month each, right? So basically, what do we have here? 2 plus 1, 3. 3 plus 3, 6 plus 3, 9 minus 3. This is going to be 6 months approximately. Fine, approximately 6 months is your working capital cycle. Now, you will get back this amount after a period of 6 months. Now, when you get back this amount, you will get slightly more than this, slightly more than 1,66,250. Why? Because you will be getting along with the profit, correct? Now, this extra amount, if you want, you can take it out of the cycle. But once again, for the next cycle, you should reinvest 166,250. Are you clear with this? And now what happens? It generates slightly extra than that. It keeps on going like this. Or in other words, in 1 year, in this case, in this example, if working capital cycle is 6 months, in 1 year, you have 2 cycles, correct? In a year, you have 12 months, and one cycle is for a period of 6 months. So in this case, in a year, you can have 2 working capital cycles. Are you clear with this? Are you clear with this? And then what happens? Since I'm able to generate more than the amount that I have actually invested. So what happens? This extra money that I have, using this, I can service my loan also and balance whatever money I have. I can use it as my profit. Are you clear with this? So this is the main reason why companies, or the economy itself, is thriving. Without working capital borrowings, without working capital funding, no company can work. The banks are happy because they earn interest. Now, these companies are happy. The businessmen, they are also happy. The entrepreneurs are happy because they get the money, right money in the time, so that they are able to run the show. And then whatever profit that they generate out of that, they pay the interest balance amount, they enjoy it for themselves. And this cycle keeps on going forever, till the time the company permanently shuts down. So this amount which they are borrowing as working capital, this cannot be repaid after one cycle because it gets reinvested. So permanently this will remain in your business, correct? And every time, parallelly, you will also be servicing the loan by way of paying an interest. Are you clear with this? This is a very, very important understanding of working capital. So you cannot just directly jump into this and say, okay, current asset minus current liability, that's all. No. You need to understand under each components of current assets, how much is the amount that gets blocked. We are not calculating the cost. We are taking the annual cost. On that, we are saying in one cycle, how much is the amount that gets blocked. So we are trying to find out how much is the amount of working capital investment required To that extent, I will have to finance it. Are you clear with this? So this is the overall story about this working capital initial, the first unit of working capital management. So with this, we have finished the first part, which is the most important part, which is introduction to working capital management. So now let's go to the second unit, which is treasury and cash management. Now let's get into the second unit of this particular chapter, which is treasury and cash management. Now, what does this area talk about? This talks about how well you're going to manage your cash. This exclusively talks about the cash component. Cash, by cash, I mean cash or bank. Clear? Fine. So this cash and bank is one of the items in your current assets. So we are just going to see how this cash and bank should get managed. So basically, they've given a lot of theoretical part in this, but of course, we'll be doing a comprehensive numerical problem in this particular area as well. So you should ensure that basically with respect to cash management, remember that you should not have too much of cash balance. You should not also have too less of a cash balance. Why? Too much of idle cash is a waste. Correct? Funds idly you are keeping it, which means what? It comes with a cost. It does not come free of cost. Correct? So too much of idle funds increases your cost, whereas too less of funds is also bad. Why? It affects your liquidity. Whenever you have to make some payment, you need to make it, else it affects your reputation, it affects your business. So you should have adequate and sufficient cash balances. Are you clear with this? So now how will I control this? How will I maintain a control over this? Generally, companies prepare something called as a forecast or a budget. So this is what we are going to see in the next illustration. So this illustration, I have actually taken this from ICAI study material only. So let's actually jump to ICAI study material. So and have a look at this particular problem. It's on page number 10.52. So in case you are from the new syllabus, don't worry, this exact sum is also there in the new syllabus study material for May 2024 and onwards. This sum is there, a very, very good problem. See, the thing is actually this sum looks big. The question itself looks very big. See, it runs into 2 pages, just a question. Fine. But the solution is just 1 page. Now, many students, they don't have this energy to read this question. They feel it's very big, it's very difficult. No, big doesn't mean difficult. Now, for you to crack this sum, you don't even need to know anything related to financial management. You just need to have some common sense and logic. So, I will just read out the question for you. And then this question, I will tell you how to approach this in the exam. Mark this as important. This question can be tested. Prachi Limited is a manufacturing company producing and selling a wide range of cleaning products to wholesale customers. The company has 3 suppliers and 2 customers. So this company, Prachi Limited, they have 3 suppliers, 3 creditors they need to pay, and they have 2 debtors. They will receive money from 2 people. Correct? Prachi Limited relies on its cleared funds forecast to manage its cash. What do you mean by cleared funds forecast? What do you mean by that? Now, let us say I am depositing a check in the bank. In my bank account, I am depositing a check today. Correct? Now, for the check to be cleared and for my bank account to be credited with the money, let us say it takes 2 days. Correct? Now they are saying they will prepare all this cash budget and cash forecast only when the check gets cleared and when my bank account is reflecting the amount. They will not actually account for it, or they will not prepare, or they will not plan their budgets based on whenever they are receiving the check or whenever the transaction is happening. They will actually consider this transaction has happened only when the bank accounts gets debited or credited, or in other words, only when the amount reflects in my bank account, in my bank statement. Only then, based on that only, they prepare their cash budgets and all. This is what they are saying. That is the meaning of cleared funds forecast. Are you clear with this? You are an accounting technician for the company and have been asked to prepare a cleared funds forecast for the period Saturday, that is 7th August, to Wednesday, that is 11th August. So 7, 8, 9, 10, 11. So what we need to do, we need to prepare a cleared funds forecast. That is the cleared cash budget, cleared cash and bank budget for each of the 5 days that they have asked us to do. Are you clear with this? Very simple, no? That is, when will you actually consider things in your budget? Receipts minus payments, that is going to be your excess or your deficit cash, correct? So when will you do this? You will account for it in a particular day only when your bank account is actually reflecting this particular transaction. Yes, very simple. Now you are provided with the following information. So basically what we need to do, we need to prepare a cash budget for each of these 5 days. But remember, there is only one condition here. What is it? You should record this particular transaction only when your bank statement reflects it. So now basically, just look at this. So what they have prepared, they have prepared the cleared funds forecast for 7th, 8th, 9th, 10th and 11th. For each of these 5 days, they have prepared a forecast. Look at this. Receipts they have, minus payments they have, and you will have what? You will have the excess of cleared excess receipts over payment, that is A minus B. You have this. Now you need not know anything here. Why am I saying this? In this particular question, what we will do, since the question is big, as and when we read a particular line item, we will go and fill up this particular column. Are you clear with this? In exam, you also follow this. First, you prepare this template and you just go on. It's nothing but preparing a cash budget for each of the 5 days. But the only condition is you can record the transaction only when it reflects in your bank statement. We will see what it is. Now, first, receipts from customers. The company has how many customers? We saw 2 customers, correct? Right. Carefully listen. We are preparing this budget for 7th, 8th, 9th, 10th and 11th of August, correct? These are the 5 days. So only the banking transaction that happens for each of these 5 days should be accounted by us. Clear? So now what happens here? Look, now W Limited is whom my customer, Prachi Limited's customer. The credit period that I am giving for W Limited is 1 calendar month, correct? And for X Limited, there is no credit period, which means immediately they need to pay. W Limited generally makes the payment through a mode called BACS. It is like NEFT, IMPS, like that. BACS is one payment method. You need not know all this. They themselves have given. BACS stands for Bankers Automated Clearing Service. And it is instantaneous, meaning what? The moment they make the payment, it will immediately come to my bank account. Are you clear? The moment my customer initiates the payment from his bank account, it will be credited instantly in my bank account. This is something similar to your GPay or IMPS. Immediate transaction will happen. Now, what they have given, the sales value made on 7th of August is given. The sales value made on 7th of July is also given. Are you clear with this? Now, for W Limited, you tell me 1 month credit period we have, or in other words, during this period, I am preparing budget only for 7th, 8th, 9th, 10th, 11th of August, correct? Now, during this period, you tell me which is the amount that I will be receiving. They have 1 month credit period. So basically, this 1,30,000 of sales made 1 month before, I will be receiving it on 7th of August. Correct or not? How much is the amount I will be receiving this 1,30,000 rupees today? Yes or no? So basically, what we can do, we can immediately go to this statement and fill this up. W Limited on 7th August, you receive how much? 1,30,000 rupees. Are you clear with this? Fill it up then and there. Then now go up. Now, X Limited, there is no such thing called as credit period, which means immediate payment they need to pay. Now, what happened? 7th of July sales they have given. 7th of August sales they have given. Here, 7th of July, 1 month credit and all is not there. This is not at all relevant. Why? Because it is outside my budget period. Now, this sale of 1,80,000, this is relevant. Now, what they are doing, so if I am making the sale on 7th August, on 7th August itself, X Limited is giving me the check. Are you clear with this? But wait, what happens here? X Limited's check will be paid into Prachi's Limited bank account on the same day. I will deposit the check the same day, but it will clear on the 3rd day following the payment. Now, what happens here? If on 7th August, if they deposit the check, leave 7th August, 8th, 9th, only on 10th, this 1,80,000 will reflect in my bank statement, correct? So now what I will do here, I will go here and I will put it as 7th, nothing will happen. 8th, 9th, nothing will happen. On 10th only, this amount of 1,80,000 gets cleared in my bank account. That's why we call it as cleared fund forecast. Are you clear with this? Which means for the period of these 3 days, 1.8 lakhs remains uncleared. Yes or no? For the period of these 3 days, yes, I have received, that is, I would have accounted it in my cash book, but ideally I have not, this has not been reflected in my bank statement. Or for these 3 days, 7th, 8th and 9th, this 1,80,000 is an uncleared amount, correct? Yes, so they are parking it under uncleared funds. They are saying for the first 3 days, this 1,80,000 remains to be uncleared. Are you clear with this? So in this question, they have also asked us to prepare this uncleared funds. So we are actually mentioning that, we are mentioning it properly here and there. So what we are doing, for a period of the first 3 days, this 1,80,000 rupees remains to be uncleared. Are you clear with this? Yes. Next. What is the next transaction that they have mentioned? So this is about your receipts from customers. Next, payment to suppliers. We have 3 suppliers, right? These are payments. A Limited, B Limited, C Limited. A Limited, if I make the purchase today, I can pay him after 1 month. B Limited, if I make the purchase today, I can pay him after 3 months. C Limited, no credit, which means I need to pay immediately. Now, payment methods are all given. For A Limited, standing order, B Limited, check, and C Limited, check, right? Now, look at this. A Limited, 1 month is the credit period, correct or not? Which means the purchases that I made 1 month back, I will be paying it today, correct? Now, we are preparing budget for what period? 7th to 11th August, correct? So, between 7th to 11th August, which payments will come? The purchase made on 7th of July, correct? Or in other words, this 55,000 rupees, yes or no? So this 55,000 rupees is actually the amount of payment that comes into, 1 second. So look at this. This is 1 calendar month, right? This is 1 calendar month. So basically on 7th of August, what will be the amount that they will be paying? So what happens? What is the relevant purchases that I will be making? So that is the 1 month before, whatever was the purchase, 55,000 rupees that I need to pay. Correct or not? But wait, read this along. Prachi Limited has set up a standing order. Standing order means what? They have given an instruction to the bank for 45,000 rupees a month to pay for supplies from A Limited. So Prachi Limited has told their bankers, they have told, look, every month pay flat 45,000 rupees on 7th of every month you should pay. Correct? This payment will leave the Prachi's bank account on 7th of August. Every few months an adjustment should be made, and this adjustment is not made during this period. So technically, from a cash flow perspective, during the time that I'm mentioning, 7th, 8th, 9th, 10th, 11th, during these 5 days, what is the amount of payment that goes from Prachi Limited to A Limited? It is not 55,000. It is 45,000 rupees only. Sir, how is it enough if I pay 45,000? The adjustment, the difference amount, they will pay it later. That adjustment does not happen during our budgeted period. Are you clear with this? So technically speaking, what happens here? Only 45,000 rupees moves out of my bank account, but it happens instantaneously. Are you clear with this? So this standing instruction, standing order of 45,000 rupees, it gets debited on what date? On 7th of August. So 7th of August, the amount that gets paid to A Limited is 45,000. So immediately go down and write down 45,000. Be very careful. It's not 55,000. 55,000 is actually the purchases made. Correct? 1 month. That's what we will think. But look at the wordings. They have given some standing order and all. So whatever is the amount that they have told their bankers to pay, that amount will only move out of their bank account. Are you clear with this? Yes. Then what happens? Now, B Limited, check payment. So now what have they said? Prachi Limited will send out by post the checks to B and C Limited on 7th August. The amounts will leave its bank account on the second day following this day of posting. Now, what they are saying, now B Limited gives us 2 months credit period. So now what they are saying, so the purchase that I have made 2 months before, that will be paid today in 7th of August, correct? The purchases made on 7th of June will be paid today on 7th of August, right? Then for C Limited, no credit period, which means the purchases made today on 7th of August, that will only be paid today. Are you clear with this? So now this 75,000, and this 95,000, the checks will be posted on 7th of August, correct? Now what they are saying, will it be immediately debited, reduced from my bank account? No, they are saying it will be, the amounts will leave their account on the second day following the day of posting. So on 7th day post, 8th, 9th, on 9th, this two amounts, 75,000 to B Limited, 95,000 to C Limited, these two amount will actually be what? These two amounts will be debited only on 9th. That is, it will reduce from my bank balance only on 9th. So I will issue the check on 7th, but this amount 75,000 and 95,000 respectively will be reduced from my bank only on 9th. Are you clear with this? So what we will do, so on 9th, 75,000 and 95,000 is a payment that we are making, but this was initiated on what? On 7th. So 75 plus 95, how much is this? 1,90,000. This 1,90,000, sorry, this is 1,70,000. This 1,70,000 remains to be an uncleared amount for the first 2 days, on 7th as well as on 8th. 1,70,000 remains to be what? Uncleared. It has not yet gone out of my bank account, but I had posted it in my books of accounts as a payment. Are you clear with this? This 300 we will come to it. Maybe some other payment is there that needs to be added. Are you clear with this? So this 1,70,000 remains to be uncleared for the 2 days since the check got issued. Next, what is the next thing that they have mentioned? Wages and salary. For the month of July, for the month of August, weekly wages 12,000, 13,000, monthly salaries 56 and 59. Read this immediately. The factory wages are paid in cash wages weekly. They will be paid 1 week's wages on 11th of August for the last week's work done in July. So basically, this 12,000 rupees weekly wages will be paid on what? 11th of August. Are you clear with this? It will be paid in cash. So obviously the amount will go out of their funds immediately. So 12,000 rupees will reduce on 11th of August. So just go down and say 12,000 rupees will be reduced on 11th of August. It comes under payment. Are you clear with this? Then what about the next figure? What about the next one? The office workers are paid salaries on a monthly basis under BACS. BACS is what? That instant automatic payment. Salaries for the month of July will be paid on 7th of August. So this 56,000 rupees will move out of my bank account on 7th of August, correct? So now on 7th of August, 56,000 rupees will move out of my account by way of what? By way of salaries. Are you clear with this? Yes. Then the next one, other miscellaneous expenses. Every Saturday evening, the petty cashier withdraws 200 rupees from the company's bank account for petty cash. The money leaves Prachi's bank account straight away. So basically, Saturday evening, when is the Saturday coming here? 7th. Every Saturday, the petty cashier is withdrawing 200 rupees from the account. So immediately it gets reduced. Are you clear with this? Are you clear with this? Yes, this 200 rupees gets reduced every Saturday, right? Fine, that's a payment that goes out. Now, the room cleaner is paid 30 rupees from the petty cash every Monday morning. Very important. Now, what is this? Now, this petty cash 200 rupees is withdrawing and keeping with the cashier. Correct? I have reduced this 200 from my funds. Now, from this 200 that the cashier has in his hands, out of this he is paying 30 rupees, 20 rupees, whatever it is. Now, this will not impact my bank balance. Why? Already I have withdrawn 200 rupees. Out of that only I am spending something. So obviously it will not impact my bank account now. When I withdraw 200 rupees, that will impact my bank account. From the amount withdrawn, if I am spending it, how will it impact my bank account? Are you clear with this? We are calculating the cleared funds forecast. Are you clear with this? Yes. Next, stationery will be ordered by telephone on Sunday, 8th August to the value of 300 rupees. This is paid for by the company using their debit card, and such payments are generally seen to leave the company account the next working day. So on 8th August, I made a purchase of stationery to the extent of 300. But when will it impact my bank account? 9th August only. So what happens? On 9th of August, there is a payment of 300. But wait, this payment was initiated on 8th. So on 8th, it remains to be what? It remains to be uncleared payment. That is why here the total uncleared payment is 1,70,000 plus 300. Are you clear with this? Are you clear with this? Yes. So this is the meaning of it. This is the meaning of this. Next. 5 new softwares will be ordered over the internet on 10th of August at a total cost of 6,500. A check will be sent out on the same day. The amount will leave Prachi's bank account on the second day following the date of posting. So if I make the payment on 10th, that is if I issue a check on 10th, 11th, 12th, only on 12th, it will move out from my bank account. Now, you tell me, I am preparing this budget only up to 11th, correct? So basically, it will not impact my budget for a period of 7th to 11th August. Are you clear with this? So basically, it will not impact my clear funds for up to 11th August, correct? Because the amount gets reduced from my bank account only on the 12th. Yes, but wait, the 6,500 rupees was a transaction initiated on 10th. So for 10th and 11th, this amount of 6,500 rupees remains as an uncleared fund that got uncleared fund payment. Yes or no? That is one uncleared payment. So this 6,500 rupees remains as an uncleared payment for the last 2 days, that is 10th and 11th of August. Are you clear with this? Yes. So this is what they have given. And then the balance of Prachi's bank account will be 2 lakh rupees on 7th of August. Opening balance is 2 lakh rupees. This represents both the book balance and the cleared funds. Prepare a cleared funds forecast for a period of Saturday 7th August to 11th August inclusive using the information provided. Show clearly the uncleared funds float each day. So day wise, we have seen how much amount has received, how much amount has been paid. So every day, we are just calculating the difference between the two. So 1 lakh 30 minus 1 lakh 1,200. So excess amount, how much? Day 1, that is on 7th of August, I have how much excess? 28,800. The opening balance is already 2 lakhs. This is given in the question. So the cleared closing balance is 2,28,800. Yes or no? Now this closing balance will become the opening balance of the next day. In the next day, there is no receipts, no payments, no transactions. So that will automatically become the closing balance. Fine. This closing balance will become the opening balance for the next day. Yes. In the next day, what happened? There was no receipts, but there was only payment of 1,70,300. So minus 1,70,300. The closing balance will be 58,500. This 58,500 becomes the opening balance for the next day. In the next day, if you see, there is only a receipt and no payment to the extent of 1,80,000. So 1,80,000 plus 58,500. The closing balance for the next day is going to be 2,38,500. This becomes the opening balance for the last day, 11th August. So now for the last day, if you see, no receipts but only payment. So minus 12,000 is the amount that has gone outside the bank account. So 2,38,500 minus 12,000. So the clear fund balance as on 11th August, the last day, is going to be 2,26,500. Are you clear with this? And then the uncleared float also we are actually tracking here. 180 minus 170. So on the first day, you have 10,000 rupees of uncleared float. Second day, 9,700. The third day, 1,80,000. On the fourth day, minus 6,500. Sixth day, minus 6,500. What is the meaning of all this? To the extent of net amount of 10,000 rupees, net amount of 10,000 rupees. So I am yet to receive. That is, the transaction has been initiated, but my bank account is not yet credited with respect to 10,000 rupees. It is uncleared fund. Are you clear with this? Uncleared fund. Then on the second day, if you see, still I am yet to receive 9,700 rupees. It is a transaction that has been initiated, but it has yet to be reflecting in my bank account. Then on the third day, if you see, 1,80,000 rupees I am about to receive, but it is not yet reflecting in my bank account. On the fourth day, if you see, actually 6,500 rupees of payment I should have made, but it is actually, the payment was initiated, but it is not yet reflected in my bank statement. And on the fifth day also, the same 6,500 rupees of transaction which was initiated but still not reflecting in my books. This is only being mentioned here. So this is actually, these amounts are recorded in my books, but they are not reflecting in my bank statement. This is similar to the BRS that we do. So the clear funds plus the uncleared funds gives you the total book balance. So 2,28,800 is the actual balance that I have in my account plus 10,000 rupees. I know that I will be receiving it in the next 1 or 2 days. That's because of my clearing difference and all. So the total book balance is this cleared balance plus my uncleared fund float. It's going to be 2,38,800. Here it's going to be 3,38,500. 2,38,500, 2,38,500. Look at this. For the fourth and fifth day, I have a cleared balance of 2,38,500, but I am about to pay 6,500. I've initiated the transaction, which is not reflected in my books. So the net balance is only 2,32,000, and on the last day also the balance is 2,20,000. Are you clear with this? So basically the sum is actually easy provided you know what you are doing and how you do it. So there is actually a way in which you do the question. So once you read this question, what you can do is quickly give it a glance once and then prepare this template. As and when you read a paragraph fully, just go and do the posting, so that by the time you finish reading the question itself, you will be done with about 80% of the problem and this entire sum will be over. Clear with this? If at all this comes, this can come for a 10-mark question. And this is nothing but logic, common sense. Just because the sum is big, some students find it difficult. So please don't fall into the trap of feeling that this sum is difficult and all. It's pretty much a straightforward question. Are you clear with this? Are you clear with this? Yes. So with this, we have finished the cash management. Of course, in cash management, it's more to do with how do you manage your cashes and how do you manage your cash and all that. Fine. There are also different, a few other problems, but in this marathon, I wanted to cover the important aspect that is covered in our cash management. So that is what we have seen now. So now let's move to the next unit. Let's now move to the next unit. So now let's move to the third unit in this particular chapter, which is inventory management, right? So technically this segment of the chapter is actually covered in costing. It's covered in your cost and management accounting. There is a concept called as EOQ, economic order quantity, and there is a concept called as stock levels. Okay, so EOQ actually is nothing but how much quantity should I place an order for. So every time I place an order from the supplier, how many units I should place an order for. And the stock levels has something like minimum level, maximum level, reorder level. Reorder level means when I should place an order. EOQ stands for whenever I'm placing an order, for how much quantity I should place an order. Now, why are all these things coming under working capital management? Because this squarely comes within the ambit of inventory management. Now, similar to any other component of working capital, inventory, we should maintain adequate inventory. We should not have too much of inventory. Why? If you have too much of inventory, you are actually blocking your funds on idle inventory. Inventory is a dead stock, correct? If you have too much of non-moving stock, it means that you need to bring in more capital, and every rupee that you bring into the business for your working capital, it has a cost associated with it. It should also not be too less. Why? If it is less, then you will run out of your orders. So whenever you're getting an order, since if you don't have the stock, then you will not be able to you will not be able to produce the products, because if your raw material, you don't have the stock, how can you start your production and honor your commitments? Are you clear with this? So basically, you should not have too much of stock. You should also not have too less of stock. There should be an optimum stock that you need to maintain. Are you clear with this? That's why they've also given inventory management has been discussed in detail in chapter 2, that is material cost chapter. Clear? So now we will just do one question in this particular area. Technically, it is covered in costing, nothing related to your financial management. It's covered in costing, but anyways, I will just do this sum just so that you can get a hang of it. Now, problem number 3, Marvel Limited uses a large quantity of salt in its production process. Annual consumption is 60,000 tons over a 50-week working year. So every year they are consuming 60,000 tons of salt. It costs 100 rupees to initiate and process an order, and the delivery follows 2 weeks later. So if I place an order today, after 2 weeks only the delivery will happen. Storage costs for the salt are estimated at 0.1 rupees per ton per annum. And so this is basically your carrying cost. Yes, this is basically your cost of holding it, holding cost or carrying cost, right? The current practice is to order twice a year when the stock falls to 10,000 tons. Identify an appropriate ordering policy for Marvel Limited and contrast it with the cost of the current policy. Now, there is a concept in material cost called as EOQ, economic order quantity, right? Now, in case you do not know this, you can refer the costing marathon video that we have uploaded. In that, in part 1 itself, I have discussed in detail about this material cost concept. You can just go and watch it. It's available on YouTube on our channel, right? So now in this EOQ, we would have learned what do you mean by EOQ? Economic order quantity. How many units should I place an order for so that my overall cost is kept minimum? The logic for this formula and all is explained. So the EOQ is actually root of 2 into A into O divided by C, where A stands for annual raw material consumption, that is 60,000 tons. Correct? O stands for ordering cost per order, that is rupees 100, and C stands for carrying cost per unit per annum, which is rupees 0.10. So how many units should I place an order for? Root of 2 into A, that is annual requirement 60,000 into O 100 divided by 0.10. So if you calculate this, you will get how much? 10,954. So it is the best optimum quantity is actually 10,954. So every time you place an order, you should place an order for how many tons of raw material? 10,954 tons of raw material, which means in a year, how many number of times you will order? Overall, I need 60,000 tons. Every time I am placing an order, I will place an order for 10,954 tons, which means in a year, I will place an order for representatively 5.5 times. So the number of orders that happens in a year is 5.5 times. Are you clear with this? Yes. Then. Now, what is your reorder level? What is your reorder level? So basically, what do you mean by reorder level? So reorder quantity, that is EOQ, stands for how many kgs to order, whereas reorder level means when to order. Correct? So reorder level is nothing but so what is your reorder level? So reorder level is your lead time into consumption per day or per week of lead time. Correct? Yes, all these things are covered in costing actually, right? So what is the lead time that it generally takes here? What is the lead time that he generally takes? He takes, if I place an order today, it takes him 2 weeks to deliver the product. Yes or no? So they have given it here. So it takes 2 weeks to deliver the product. Yes. So it takes 2 weeks to deliver the product. And what is the consumption per week? So 60,000 is the annual consumption, and in a year there are 50 weeks. So basically I should make sure that the moment my stock touches this level, I should pick the phone and place an order for how many kgs? For 10,954 kgs or tons. Are you clear with this? So what is the reorder level? The reorder level is 2,400. So what do you mean by 2,400? The moment my stock balance is reaching at 2,400, I will pick the phone and I will place an order for 10,954 tons. Are you clear with this? And when we do this, automatically your overall cost will be minimum. This is what the concept of EOQ says. So the total cost at optimum policy. Optimum policy means what? If your order quantity is at EOQ, that is 10,954. So what is your total cost? Total cost is holding cost plus ordering cost. So what is your holding cost? So holding cost is nothing but average inventory into C, that is carrying cost per unit per annum. Yes or no? Now average inventory. What is the average inventory that you will keep? What is the average inventory that you will keep? Average inventory. Now if you see here, at every point of time, see, if you place an order, you will get for 10,954 units. Correct? So by the time it reaches the delivery, by the time the supplier delivers your product to you, again you will get this 10,954 units. Or in other words, at one point of time in a period, there will be 10,954 kgs in your tons sitting in your warehouse. At some point there will be 0. So the average inventory will be half of 10,954. Yes, or in other words, half of order quantity, half of EOQ is your average inventory. So 1 by 2 into 10,954. This is going to be your average inventory into carrying cost per unit per annum. It is going to be how much? Into 0.1. Are you clear with this? So this is going to be your overall holding cost or carrying cost. So 0.1 into 10,954 divided by 2. Why this divided by 2? This is nothing but average inventory into carrying cost per unit per annum. Then what is your ordering cost? Ordering cost per order into number of orders. So what is the number of orders? Annual requirement, that is I need 60,000 tons every year. Every time I place an order, I place an order for 10,954 tons. So which means 60,000 divided by 10,954, I am placing 5.5 orders in a year, and every time I place an order, I incur a cost of 100 rupees. Yes or no? So basically the ordering cost will be 100 into 60,000 divided by 10,954. So basically it is going to be 547.7 plus 547.74. So your overall cost is going to be 1,095 if you are maintaining, if you are placing an order at your economic order quantity level. If you are following the economic order quantity, your overall cost will be 1,095. Are you clear with this? Now what they are given, currently what the company is doing, the company is only ordering twice a year, and that too when the stock balance falls at 10,000 tons. So which means twice a year, which means every time they place an order, in a year they place an order only 2 times. So every time they place an order, for how many tons? 30,000 tons. Yes or no? So in one order that is 30,000 tons, and like that in a year they are ordering twice. Correct? Yes. So now are they following the EOQ? No. EOQ says every time you place an order, you should place an order only for 10,954 tons. Correct? Whereas they are placing an order for 30,000 tons. So obviously, since they are deviating from EOQ, they will be incurring more cost. This is what we saw in material cost chapter, right? That is exactly given. Nothing new that we are learning. Every single thing is the same. So now what they have given here. So to compare the optimum policy with the current policy, the average level of stock under the current policy must be found. Why we should calculate the average stock under the current policy? Yes. Now, what is my holding cost and what is my ordering cost? Holding cost is average inventory into carrying cost per unit per order. What is my ordering cost? Ordering cost is nothing but number of orders in a year multiplied by ordering cost per order. Yes or no? Now holding cost is average inventory into the carrying cost per unit per annum. What is the carrying cost per unit per annum? The carrying cost per unit per annum is 0.1. Now you tell me what is going to be my average inventory. Now what they are saying is, look at this. I will place an order every time my stock reaches 10,000 tons. Correct? Right? So I will place an order every time my stock reaches 10,000 tons. Yes or no? My stock reaches 10,000 tons. Now it takes 2 weeks for the person to deliver it. Yes or no? So before the delivery happens, so I will pick the phone call, and the moment my stock balance is 10,000, I will pick the phone call. By the time he delivers, my stock balance will be reducing by how much? So 2 weeks consumption. Every week, in a year, I will consume 60,000. In a year, I will consume 60,000 tons, which means on an average, every week I will consume how much? 60,000 divided by 50, right? Like the 2 weeks it takes. So 60,000 divided by 50 into 2. So by the time the delivery happens, I would have already consumed how much? 2,400 tons. Yes or no? Yes or no? So technically at the time of delivery, my stock balance would have reduced to how much? 7,600. Yes. Now this guy is going to deliver how many kgs? 30,000 kgs. We just found out they are going to place an order only for two times in a year. So 30,000 kgs. So now the stock gets replenished by 30,000 kgs. So what is the maximum stock that you will be having? 7,600 is the minimum stock. What is the maximum stock? It's going to be 37,600. Yes, because plus 30,000, it's going to be 37,600. So the average stock will be the maximum stock plus the minimum stock divided by 2. So your average stock is going to be how much? Your average stock, that is a simple average way of computing, or you can also do it as minimum stock plus 1 by 2 of order quantity. I told you there are 2 formulas to calculate average stock. In costing we have seen. Yes. So what are the 2 formulas to calculate average stock? One is actually a simple average, that is minimum plus maximum by 2. That is arithmetically correct but practically not correct. Whereas the other formula is very logical. Minimum plus EOQ by 2. That is The stock fluctuation will happen only above the minimum level. So you take the average of my EOQ. So what is the EOQ? In this case, order quantity. What is the order quantity? 30,000. So 30,000 divided by 2 plus the minimum stock of 7,600. So the average stock gives you 22,600. So 22,600 into 0.1. This is going to be your overall carrying cost or holding cost. Then what is going to be your ordering cost? It is going to be number of orders, that is 2 into ordering cost plus per order. So the overall cost, if I am placing an order twice in a year, is going to be 2,460, whereas if I follow EOQ, it is just going to be 1095. So how much extra cost I am incurring because I am deviating from EOQ? So the difference between that 2460 minus 1095, so that gives you how much? 1365 rupees per year. So every year I am incurring an extra cost of 1365 because I am deviating from my EOQ. So it is better to follow EOQ. Are you clear with this? Technically, this entire discussion is not even pertaining to financial management. It is exact copy paste of your costing. In fact, in the new syllabus, what they have done is, so in the old syllabus, at least they had mentioned all these things and they had given some illustration. In new syllabus, what they have done from May 2024 onwards, they have just mentioned in a single line, they have mentioned refer material cost chapter in your costing. So this is nowhere, they have not mentioned separately things here. They have just said refer that costing syllabus. So they have just mentioned this as unit 3 management of inventory, refer your costing syllabus, your material cost chapter. That's all they have done. They have just mentioned this part alone. Are you clear with this? In old syllabus, at least they have just mentioned a few things and given a few illustrations. That doesn't mean that these questions will not be tested. So please have that in your mind. This is equally applicable for new syllabus students as well. Clear? So with this, the small area inventory management is also over. Now, let's get started with the unit 4 in this working capital management chapter, which is management of receivables. So basically, receivables stands for what? Your debtors. Predominantly, it stands for your debtors, of course, bills receivable also, right? So the people who owe some money to the firm, to the particular company, is called as what? They are called as debtors or receivables. Now, what is the point here? What is the point of discussion here? Now, there is some money that gets blocked in this debtors category. It is a part of current assets. I am making the sale today, right? But let us say I am getting the payment after 2 months. I'm getting the payment after 2 months. So for this 2 months, there is some amount that gets blocked by way of debtors, correct? So now this needs to be taken care of by the company, right? So what they can do is they can have a look at their credit terms. They can have a look at their credit terms and they can be more cautious about it. Now, what they can do is they can maybe give a credit term of 3 months, or maybe they can give a credit term of 2 months, or they can maybe give a credit term of 1 month, as the case may be. So they can evaluate whichever option is the best for them. Sir, what is there in evaluating this? If you give more credit term, what will happen? The chances of your sales will be more. More people will be willing to buy from you. But what is the problem if you give more credit term? The chances of bad debts is also more. Why? Because now they are taking more time. People are coming to you because you are giving more time. These people can be intentional defaulters also. The chances of bad debts is more. That is number one. And also more the credit period, now more will be the amount funds blocked in it by way of working capital, and hence the cost associated to working capital will also be more. So basically, if you increase your credit term to your debtors, the advantage is you can improve your sales, but the disadvantage is the chances of bad debts will be more. Also, there will be a cost associated with the funds that get blocked, more the credit period, more the capital that gets blocked under working capital. Are you clear with this? So what the company needs to do, they need to do some cost benefit analysis for each of these things, for each of the methods, for each of these 3 proposals, in our case the 3 proposals, and they can find out whichever is that method that gives them the maximum net benefits. They can go for that particular option. Are you clear with this? So aspects of management of debtors, basically it's about the credit policy. Fine. What is the credit terms I should give them? 1 month or 2 month or 3 month, as the case may be. Credit analysis, that is at the time when I am choosing my customer, I should see whether this guy is going to repay me or not, whether he's credit worthy or not. The credit worthiness should also be seen. This involves due diligence or reputation check of the customers with respect to the credit worthiness. Are you clear with this? And then control of receivables. You should have a dedicated team to follow up on the payments and all that and ensure that this guy makes the payment on time. Are you clear with this? So following up with the data and all that. Now, in this context, there is a very interesting area called as factoring. There is an interesting area called as factoring. Sir, what is this concept of factoring? Now, let us say a company A Limited, there is a company A Limited, they have sold some goods on credit to a customer, right? The credit period is, let us say 3 months. Now, A Limited, what they need to do, they need to wait for 3 months. At the end of 3 months, this customer will pay to A Limited and this transaction gets complete. There is an other alternative. What is the alternative? This is kind of similar to that bills discounting. But here it is not a bills receivable, it's a normal debtor. Okay? It can also be a bills receivable. Now what this A Limited will do, it made the sale today. Immediately today itself, it goes to a person called as a factor. What this guy will do is, he will say, I am ready to buy your debtor. And he will pay A Limited an upfront amount. But he will charge some commission. This is similar to the discount that banks will charge. Why is he charging a commission? Because later on this factor, he will go and collect the payment from the customer. So the customer will now not make the payment to A Limited. The customer will make the payment to factor, but after 3 months. But this factor pays A Limited today itself. So he is technically funding A Limited for the next 3 months, for which he charges something called as a commission, and this concept is called as factoring. Now every time when there is actually a debtor and when you have a possibility of factoring, you should see whether this factoring is beneficial for you or not. Sir, how does factoring benefit me? Sir, always I should pay this guy a commission. Yes. But what happens is, you need not incur some administrative cost with respect to following up with the customer. You need not have a separate team to actually go and follow up with the customer and all that. All these things, this factor will take care of. Are you clear with this? In fact, at times, the factor will also take care of the risk of the bad debts. Suppose there is any bad debts, this factor himself will bear it. He will not pass it on to A Limited. Accordingly, his commission will be more. So if the factor is bearing the bad debts, it's called as a non-recourse factor. So if the factor is not bearing the bad debts, he says, no, if there is a bad debt, then I will catch A Limited. It's called as a recourse factor. So non-recourse factor will bear the bad debts. Obviously, more the risk, he will expect more commission and all that. Are you clear with this? And this concept is very similar to the bills discounting. Instead of this factor in bills discounting, we have the bank which discounts the bill upfront. Instead of paying 100 rupees, they will pay 90 rupees to the A Limited and they will recover 100 rupees after 3 months. Something like that. Yes. So this difference is the earnings for the factor, but they are taking the risk of what? They are taking the risk of the bad debts in case they are a non-recourse factor. And one more thing is that they take care of all the administrative costs with respect to collecting the money from the debtor. Are you clear with this? In this context, we should see whether it is worthwhile going for the factor or not. So that is what we are going to discuss in this segment. A factoring firm, question number 4, a factoring firm has credit sales of 360 lakhs, right? And its average collection period is 30 days. So what they are saying, this is actually not a factoring firm. It's a normal firm, okay? It's a normal company. They have credit sales of 360 lakhs in a year and its average collection period is how much? 30 days. So in a year, they have how much sales? 360. So what is one operating cycle's debtor's value into 30 divided by 360? So can we say that in one cycle, they have a debtor balance of 30 lakhs, or in other words, the amount that gets blocked by way of debtors is going to be 30 lakhs for this company. The finance controller of the company estimates that the bad debt losses are approximately 2% of the credit sales. The firm currently spends 1,40,000 annually on the debtors administration, like telephone, the calls, and sending recovery agents and all that. This cost comprises of, look at this, telephonic bills, fax bills, along with the salaries of staff members. And these are avoidable costs. When can they be avoided? If you are appointing a factor. Now, a factoring firm has offered to buy the firm's receivable. Now, what this factoring firm says, look, 30 lakhs is your receivables. We will buy it from you. Meaning what? We will buy this. We will be the owners of this 30 lakhs. We will pay you some money today itself. At the end of the credit period, we will collect it. At the end of 30 days, we will collect it from the debtors. If there is any bad debts, we will bear it. Are you clear with this? How do we know they are bearing it? They are saying it's all avoidable cost. Clear? Factoring firm is offered to buy the firm's receivable. The factor will charge 1% commission and will pay an advance against the receivable on an interest of 15% per annum after withholding 10% as reserve. Analyze what the firm should do. Assume 360 days in a year. Now, what is this? Now, very, very beautiful calculation. Time and again, students make a mistake here. Maybe if this can come for a 5-mark question. The other areas in receivable management are fairly simple and straightforward. This is the place where generally students find it difficult. And I think this is the only question given in your illustration regarding your factoring. So please pay attention to this. Now, what they are saying is, first, what is my debtor's value? My debtor's value is 30 lakhs, correct? Now, this guy factor, he says, I am going to charge you 1% of the debtor's value as commission. So what is his commission? His commission is going to be 30,000 rupees. Now he is also telling one more thing, right? So 30 lakhs is the value of debtors for which he is willing to purchase from you. Now he's saying, look, that entire 30 lakhs I will not pay you today. I will withhold 10% for what? It is going to be for my security purpose. I will withhold this. This 10% I am withholding, is it a cost? No. After this 30 days, I will pay it back to you the moment I collect it from your debtor. Clear? So the factoring firm says 10% alone I will withhold. So for safety purpose, at the end of 30 days, the balance 10%, I will release the payment. So initially, I will release only 90% of the payment. Are you clear with this? So basically, the factoring commission is how much? 1%. Reserve, how much amount is he withholding? 10% of 30 lakhs, it's going to be 3 lakh rupees. So now what this factor says is, so now today I am purchasing the debtors worth how much? 30 lakhs from the company, correct? Now from this 30 lakhs, I will withhold 3 lakh rupees, that is reserve, correct? So balance 27 lakhs I will pay. No, he's saying my commission, you need to pay me 30,000. That also I will deduct it upfront. So this 30,000, it needs to be paid by this company to the factor, correct? So now what the factor says is, I need to pay you 30 lakhs minus 10%. I am putting it as my cushion, minus 30,000. That also I will just reduce it, and the remaining amount only I am just going to remit it back to you. So basically he says 3,30,000 rupees he will withhold upfront. Are you clear with this? That is 30,000 rupees with respect to the factoring commission and 3 lakh rupees with respect to reserve. He says this 3,30,000 upfront I will not give you. This I will keep it with myself, because 30,000 is anyways the money that you need to pay to me. 3 lakhs is I am keeping it for security purpose. After 30 days, the moment I recover money from the customer, I will pay this back to you. Are you clear with this? Now, not just that, he is saying one more thing. Now, technically, how much is the amount that he is going to release for funding? 30 lakhs minus 3.3 lakhs, correct? So this is technically how much, guys? This is going to be 26 lakhs 70,000. So he will release 26 lakhs 70,000 to him today itself. Today, you have made the sale today. So you are going to a factor. The factor says, I will pay you 30 lakhs, but wait, I will withhold 3 lakh rupees pertaining to my reserve, 30,000 rupees pertaining to my commission. So I am going to fund you today itself. I will pay you 26 lakhs 70,000, correct? But wait. He says this 26 lakh 70,000 I am funding to you today, it is going to be against an interest of 15%. Why? So this guy is saying, come on, I am going to bear your risk, correct? I am going to bear your risk. Not just that, for 30 days I am going to finance you. If you are able to, if you want to do it by yourself, you need to incur some extra cost plus wait for 30 days. Whereas if you're doing it through me, you just need to pay me a commission. And of course, for the 30 days, whatever I'm funding you, that portion, you need to pay me some interest. So now how much amount is this factor funding him? Today itself, he's ready to pay 26,70,000. So what is the interest applicable on that? He's going to fund only for 30 days. Correct? So this is going to be 26,70,000 into 15 percentage into 30 divided by 360. So how much is this going to be? So 26,70,000 into 0.15 into 30 upon 360. So this is going to be 3,375 rupees. This is payable as interest. So he's saying from this amount that I'm going to disperse you, the interest also I will deduct it upfront. So the net amount that I will release today is going to be 26,36,625. Are you clear with this calculation? So basically we found the debtor's value. This entire value will the factor give it today? No. For cushion purpose, for the safety purpose, he will withhold 10%, that is 3 lakh. Then he is charging a commission, that also he will withhold at the time of payment itself. So 3,30,000. So the net amount he is ready to release or fund is 26.7 lakhs. On this 15% per annum for 30 days, he will compute the interest. That also he is deducting upfront. So all his fees and all he is deducting upfront, fees and interest, and net amount only he will release it to the company. Are you clear with this? So the company will get today, net amount the company gets is 26,36,625. Are you clear with this? Yes. Now, because the company goes to the factor, what is the benefit? Benefit number one, the company can save on what? The cost of administration. They had given all this fax and all this admin staff and all 1,40,000 I can save. Yes. Then the company can also save what? The cost of bad debts. Yes. So 2% on annual sales is generally my bad debts. Every time I make a sale, I'm going to repeat this. So once in every 30 days, this again, I'm going to make what? This 30 lakhs rupees worth of sale. Correct or not? So 30 lakhs again and again, every 30 days I do. So in a year, I will actually factor the entire 360 lakhs worth of sale. At a time, I will factor only how much? 30 lakhs. But anyways, it gets factored again and again in a year. So obviously what happens here? What happens here is, so here the entire bad debts cost, this can also be saved. 2% on 360 lakh, 7 lakh 20,000. So how much amount you are able to benefit because you're going for the factor? 8 lakh 60,000. But wait, is there a cost associated with it? Yes, there is a cost associated with it. So what is the cost? There are only two costs. What are the costs here? Factoring commission and interest charges. Remember that reserve amount is not a cost. He will release it after 30 days. So don't worry about it. That is just he withholding it for security purpose. Now factoring commission, how much is it? How much is it? Commission is 30,000 rupees. Correct? 30,000 rupees. But remember, this 30,000 rupees is pertaining to one cycle of 30 days. Correct? In a year, they keep on doing it. So basically, 30,000 rupees is for 30 days. How much is it for 360 days? Because the moment 30 days gets over, again this company will go to a factor, the new debtor will come, for them the next 30 days they will fund. Like this, it keeps on moving. So technically throughout the year they will be funded by this factor. 30,000 upon 30 into 360. Annually the factoring commission is how much? 3,60,000 rupees. Correct? Similarly, the interest charge is also 33,375, that is pertaining to one period, that is pertaining to 30 days. Like that, how many days are there in a year? 360 days. So 33,375 upon 30 into 360. So that gives you how much? 4 lakh and 500. So what is your total cost that you incur, extra cost you incur because of factoring? 7,60,500. What is the total benefit you get because of factoring? 8,60,000. So the net benefits the firm is 99,500. Or in other words, if you do this factoring, if you go for this factors method of funding, you will gain a net amount of 99,500. So is it worthwhile to go for factoring or not? Yes. Since the savings to the firm exceeds the cost of the firm on account of factoring, the proposal is acceptable. Are you clear with this? So basically this factoring is nothing but almost similar to the bill discounting concept, discounting of bills of exchange, but here it is done by a third party called as factor, for which he charges a commission and also charges an interest, and all these things he deducts upfront. Are you clear with this? But for that, there is no difficult areas in this particular concept of receivables management. So with this, we have finished this part as well of receivables management. So now let's move to the next unit of discussion. Now, this is unit 5, which is management of payables, that is creditor. Now you tell me, these guys, the creditors of a company, they technically fund you They technically fund you, but not by giving you money, but they fund in kind. That is, they sell the products today and they are ready to accept the payment at a later date, correct? So indirectly, this is also a source of working capital finance only. Now, with respect to management of payables, what is the issue here? What is the issue? What needs to be done here? So there are some costs for availing the trade credit. Now, if I go for a trade credit, that is, if I want to purchase on credit, if I want to make purchase credits, it is actually not free of cost. It comes with some cost. What is it? Number one, price. Now, if you see, if you paid by cash today and purchase, or against that, if you actually purchase something on credit, there will definitely be a price difference. What is it? So basically, if you pay today and purchase it, this guy, the supplier, will give you a discount. Why? Because you're making the payment today itself and you're carrying it. Yes, you're taking the goods, cash and carry model, correct? Suppose you are saying I want 3 months credit and all, so this guy will not give you the discount. So technically you are losing out on the discount because you are going for a credit period. Are you clear with this? So because of going for credit, there are some prices like this one. The first one is a change in the price. Number two, suppose if you do not keep up with your commitment, you are saying that you will pay after 30 days, but you are not paying after 30 days, it amounts to loss of goodwill. So this is basically a qualitative factor. This cannot be quantified in monetary terms, but yes, this will result in cost of goodwill, loss of goodwill. Then since you are having a lot of suppliers, now you need to have a separate team and incur some administrative costs. And of course, there are some conditions that you need to abide by. Sometimes most of the suppliers insist that for availing the credit facility, the order should be of some minimum size or even on a regular basis. Just like that and all, they will not give credit facility for every customer. So the suppliers will say you need to purchase a minimum of so much, or you should purchase every month you need to purchase. So all these kind of conditions they will do. But there are some costs of not taking the credit. That is, these are some benefits of taking credit. What are the benefits of purchasing on credit? The first one is impact of inflation. Assume there is no concept of credit purchase. Now what will happen? You can purchase only when you have the money, correct? Let us say in the month of Jan, you wanted to purchase something, but you didn't have the money. Now you got the money somewhere in the month of Feb. But what happened between this Jan and Feb? There happened an inflation, and because of this, the per unit price went up. Now you tell me, had you purchased the products on credit, you could have purchased it in the month of Jan itself at the price prevailing in the month of Jan. Correct? The payment could have been done on a later date, no problem. Whereas now that you do not have this model of cash, suppose if you do not have this model of credit, if you need to pay by cash, now you need to purchase it only in the month of Feb when the prices have gone up. Or in other words, when there is an inflation, not taking a credit will actually make you lose some money. Are you clear? On other words, when there is an inflation, when prices are rising, it is better to go for credit period. That is, it is better to purchase goods by using a credit period because make some credit purchases, because now you will purchase it at a time when the prices are relatively lower. At the time of payment, even when the prices are higher, you need to only pay that amount which was prevailing at the time of purchase. Correct or not? This is what it is. Number two, yes, we know that the trade credit is typically an interest-free loan. This is what I said. It is technically funded. It is funded by way of non-cash item. That is, it is not a monetary way of funding, but through materials they are funding it. So it comes free of interest. That's what they are saying. And number three, inconvenience. Sometimes you might not be having cash whenever you want to purchase. So now in that case, all this taking up credit from the supplier will help you. So this is also one more advantage of taking credit. See how they have used this double negative. Cost of not taking credit, which means benefit of taking credit. Are you clear with this? That is what they have mentioned. Now in this segment, generally the problem arises with respect to cash discount. The problem arises with respect to cash discount. This is one very good sum given in the institute study material that we are going to solve right now. So please pay attention to this. Now many students do not understand this question itself. So first let me read the question and explain you what is the decision that we need to take. The dolls company purchases raw material on terms of 2 by 10 net 30. First, wait, what do you mean by 2 by 10 net 30? Now, generally the supplier is telling you, so you are the customer, there is another supplier from whom you are purchasing the goods. He is telling you that the normal credit period is what? You need to make the payment by 30 days, correct? But if you make the payment before 10 days, if you make the payment by 10 days, I will give you a cash discount of 2%. Clear with this? Now you read this. 2 by 10 net 30 means what? 30 days is the general credit period. You need to make the payment anyways by 30 days, but if you make the payment within 10 days, you are eligible for a discount of 2%. This is called as 2 by 10 net 30. It could be anything. 1 by 20 net 40 also it can be. Are you clear with this? But whenever they give this word, understand the meaning of it. It means this 30 stands for the general credit period, maximum credit period, but this 10 stands for the credit period before which if you pay, you will get a discount of how much? 2%. Are you clear with this? This is the meaning of this 4 words given here, 2 by 10 and 30. Clear with this, guys? Now, a review of the company's records by the owner, Mr. Gautam, revealed that payments are usually made 15 days after the purchases are made. So generally what this company is doing, their past record shows that the company is making the payment after 15 days only, which means are they enjoying this cash discount? No, they are not enjoying this cash discount, right? Now look at this. When asked why the firm did not take advantage of its discount, the accountant, Mr. Rohit, replied that it cost only 2% for these funds, whereas a bank loan would cost 12%. Now, what is the justification which Mr. Rohit is saying? Sir, now we are paying after 15 days, correct? Suppose we need to pay it 5 days in advance. That is, if I want to avail the discount, correct, I need to make the payment by the 10th day, correct or not? So technically speaking, what I need to do is, if I have to make the payment 5 days in advance, now I don't have the funds with me. I need to borrow the money from the bank, correct? If I borrow the money from the bank, it will cost me 12% interest, correct? Now, why should I pay 12% to get a discount of only 2%? This is the logic that Mr. Rohit, the accountant, is saying. Are you clear? Currently, the company is paying it within 15 days. Now, the owner, Mr. Gautam, is asking why you are not availing the cash discount by paying it within 10 days. He's saying, if you want me to make the payment before 5 days, then I don't have the money. I should borrow it from the bank. Bank interest will cost 12%. Why should we borrow money by paying 12% interest to get a benefit of 2% discount? It doesn't make sense. This is the illogical explanation that Mr. Rohit is giving. Clear with this? Yes. Analyze what mistake Rohit is making. Number 2, if the firm could not borrow from the bank and was forced to resort to use the credit funds of trade funds, then what suggestion might be made to Rohit that would reduce the annual interest cost identified? Now, first of all, you understand one thing. This 12% is per annum, whereas this 2%, what this guy is saying is, I will give you a discount of 2% provided you make the payment 5 days earlier. So technically this 2% is pertaining to 5 days. This 12% is pertaining to 365 days. These two are not comparable as such. But this guy, the accountant, he has made a mistake in comparing these two assets. Are you clear with this? So Rohit's argument of comparing the 2% discount with 12% bank loan rate is not rational, as 2% discount can be earned by making the payment 5 days in advance. Whereas, so that is within 10 days rather than 15 days, right? Whereas the bank loan of 12% is a cost that is incurred for a 1 year. Clear? So assume, let us say the purchase value is 100 rupees. Guys, this calculation is very important. Let us say the purchase value is 100 rupees. Now the discount that can be earned by making the payment within 10 days, that is, generally you pay it within 15 days. Now you pay it within 10 days. That is, by making 5 days in advance. If you make the payment within 10 days, how much discount you will get? 2% on 100. You will get 2 rupees discount. Correct? So the net amount that you will be paying, to your creditor, to your supplier, will only be rupees 98. Yes or no? So you will be having 2 rupees extra with yourself. Yes, guys. Clear or not? Now you tell me how much you have paid. 98 rupees only is the cost for you. Now how much you have saved? 2 rupees you have saved, correct? Now this 2 rupees is the savings for 5 days. So how much is the savings for 365 days? This 2 rupees upon 98. So this 2 rupees is the amount saved for every 98 rupees paid, and this is happening for every 5 days. So how much is your overall savings for 1 year? So it is going to be 149 percentage. If you annualize it, technically speaking, this discount can be 2 percentage on the order value. But what is happening here? Because I am making this in 5 days early, this is actually the savings made, the percentage 2 upon 98. If you see this, it is going to be 2.04 percentage. You technically save 2.04 percentage for 5 days. So how much do you save for an entire year? Technically, it's actually the annualized benefit of taking the discount is 149 percentage. You should compare this 149 percentage with 12 percentage. Now you see which is better. Obviously, if I take this, if I make use of this particular, trend, this discount that they have mentioned, that is 2 by 10 net 30. If I make the payment 5 days earlier, that is before 10 days, now I can save some discount, and the annualized cost of discount is actually 149 percentage as against 12 percentage. So it is better for me to borrow at 12 percentage, annualized 12 percentage, and pay this creditor 5 days earlier and benefit by 149 percentage. So obviously it is better to take the loan, pay this creditor 5 days before itself, that is within 10 days, and avail the benefit of 149 percentage. This 2 percentage is for 5 days. 2 upon 98. Why is it upon 98? Because 98 is the amount that I'm now net of. 98 is the amount that flows out of my, that is the cash outflow that is happening if I actually go for this discount, yes or no. So basically 2 upon 98, you will get the actual savings, the discount percentage that you earn, that is for 5 days. How much is it for 365 days? Are you clear with this? This means the cost of not taking the discount is 149 percentage. So what is suggestible? You borrow at 12 percentage, make the payment early, and avail this benefit of 149 percentage per annum. Annualized, if you annualize it, it is 149 percentage. But if you're talking about for the 5 days, it is going to be 2%. Are you clear with this? No. Now, suppose the firm could not borrow from the bank and was forced to resort the use of the credit fund, trade credit funds. What suggestion might be made to Rohit that would reduce the annual interest cost? Now, if I am able to borrow the money, I can make the payment quickly, and I can make the payment within 10 days, and I can get the discount benefit. Suppose if I am not able to get the bank loan, then what needs to be done? Then anyways you need to pay within 30 days. No doubt about that. So within 30 days you need to pay. Suppose you're not getting the loan. If you're getting the loan, pay it within 10 days, avail the discount benefit. If you're not getting the loan, definitely it needs to be it needs to be paid within 30 days. There is no second thoughts about it. That is what they have mentioned. The bank loan facility, if the bank loan facility could not be available, then in this case the company should resort to utilize the maximum credit period as possible. Therefore, the payment should be made in 30 days to reduce the interest cost. Are you clear with this? This also they will borrow. Maybe if they are not able to immediately arrange the funds, they will somehow arrange it after a period of 10 to 12 days. Yes, maybe after some time. Whatever it is, make sure that you are making the payment within 30 days, because your overall interest cost will also be minimum. Of course, the company's goodwill is also at stake. Are you clear with this? So in this case, you tell me, is it better to go for the discount? Yes, absolutely. It is better to go for the discount because it gives you a benefit of 149% annualized, correct, as compared to bank borrowing of only 12%. So borrow at 12%, make the payment early, and get a benefit of 149% in an annualized manner. Are you clear with this? And that is about this particular segment of creditors management. Now, the final part is actually financing of working capital. This is basically a theoretical part. So now, in the first segment of the chapter, we saw how do you calculate the amount of working capital required, correct? Working capital investment, how do you calculate the amount? Yes, we saw current assets minus current liabilities. We saw all those calculations with the working capital cycle and all. Now, this segment talks about how do you finance it? How do you arrange for this finance? Correct. After determining the amount of working capital required, the next step to be taken by the finance manager is to arrange the funds. As discussed earlier, it is advisable that the finance manager bifurcates the working capital requirements between permanent and temporary. So permanent working capital means what? At any given point of time, it should be there in the business. Temporary, I told you, it's only a seasonal requirement. So this needs to be classified. Permanent working capital is always needed. Hence, it should be financed through long-term sources such as debt and equity. Are you clear with this? This is where I said your working capital finance is not a short-term finance. It is a long-term source of finance that needs to be arranged. So you can also arrange it through your debt and equity channel. On the contrary, temporary working capital may be arranged through some short-term sources of finance. So broadly speaking, the working capital finance can be classified into two categories: spontaneous sources and negotiable sources. Spontaneous sources are the sources of finance which naturally arise in the course of business operation. That is nothing but your creditors, correct? Trade credit, credit from employees, credit from suppliers of services, that is outstanding wages. For 1 month delay, they will accept all these things. These are spontaneous sources, that is they are naturally bundled in the course of the business. Whereas negotiated sources is what you going to a bank and asking for some loan. On the other hand, the negotiated sources, as the name implies, are those which have to be specifically negotiated with the lenders, say commercial banks, financial institutions, general public, etc. And the finance manager has to be very careful while selecting a particular source or a combination thereof for financing of working capital. Are you clear with this? This is basically a theoretical part, and with this we have completed this particular chapter. Now this is actually a very big chapter. Working capital is actually a very big chapter. Now we have spent approximately about 2.5 hours in condensing the entire chapter on a bird's eye view, right? So this marathon will help you revise all these concepts covered in this particular chapter, because this chapter, working capital management, this is actually a very big chapter. It has 6 units inside it. I told you it's actually a big chapter. There is a lot of numerical problems that needs to be solved, that I generally do it in my regular course, but in a fast track course I wanted to touch upon the important aspects in every single unit. So that is why we have seen all the 6 units. In that, the important and the tricky areas we have explained it here. But don't think that working capital is only this much. There are some extra issues that needs to be discussed, but those issues I've just generally I cover it in my fast track. But in this marathon, whatever is important, utmost important area, I have picked it up and I have compiled it. And I think we have done about 5 questions in this particular segment. So that will do for this particular revision. Clear with this? Yes.